Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Here are the three things that you need to know to start your day. Big tech shows its hand. Microsoft's fiscal fourth quarter earnings beat on the top and bottom line, but shares fall as the tech giant reported a sequential decline in Azure cloud revenue growth. It's a different story at Alphabet. Cloud revenue lifting it to a second quarter earnings beat on revenue of $74.6 billion. Snap, perhaps the most eye-catching, however, shares plunge more than 17% on a weak forecast. Next up, we've got Meta Platforms. We're also watching shares of Coca-Cola this morning after the company saw sales rise 6% in the second quarter and hiked its full-year outlook. Adjusted earnings per share came in at 78 cents versus the 72 cents that was expected. Revenue also beating the street at $12 billion. Like many of its peers, Coke has been hiking prices as input costs rise. And happy FOMC Day to all who celebrate. The Federal Reserve is widely expected to hike rates to a 22-year high today, but the focus is going to be on any hints as to where we go from here. In June, the FOMC had penciled in a final hike later this year. Strong consumer confidence data yesterday has raised hopes the central bank can tighten policy even further without sending the economy into a deep recession.
Earnings season kicking into an even higher gear with Microsoft and Google parent company Alphabet kicking off big tech earnings this week. Microsoft's fiscal fourth quarter earnings beating on the top and bottom line. The tech company's overall revenue up 8% to just over $56 billion. Analysts had expected closer to $55.5 billion. The shares, though, are down as the tech giant reported that Azure and other cloud services revenue growth of 26% year over year was a deceleration, and that's really what the street is focusing on. Brad, for after the call, you listened to that call. So what were your impressions?
Yeah, listened to the call, combed through the transcript as well, and looked at the reaction and where particularly investors and analysts were really not impressed here. Now, a few things going into this report that we were going to be listening for. Of course, we're past the perhaps lion's share of the AI or generative AI hype phase. And so now we kind of pivot into this, well, prove it part of the narrative here. And so for Microsoft, one of the things that I was keyed into was this that they had to say on the call. This from CFO Amy Hood, who was talking about the first half of this year in comparison to the second half and where some of that capital cost structure is going to be moving. Let's run a clip of this.
At a total company level, revenue growth from our commercial business will continue to be driven by the Microsoft Cloud and will again outpace the growth from our consumer business. Even with strong demand and a leadership position, growth from our AI services will be gradual as Azure AI scales and our copilots reach general availability dates. So, for FY24, the impact will be weighted toward H2. To support our Microsoft Cloud growth and demand for our AI platform, we will accelerate investment in our cloud infrastructure. We expect capital expenditures to increase sequentially each quarter through the year as we scale to meet demand signals.
And so as we're in kind of the prove it portion of this AI or generative AI investment strategy for a lot of the major tech companies, especially in the search engine part of the economy or the broader markets out there, I should say, one thing that is going to be important, amazingly important for investors to pay close attention to is how much companies are willing to continue spending on some of those AI efforts here. And that's what I was keyed into on Microsoft's earnings. Ultimately, for my vibe check for this call here, because I don't feel like I got some of that clarity or transparency, I gave this A, and here is the drum roll and also the graphic for you. A meh. It's Microsoft for me right now. And ultimately, because I did not get that clarity, I also think Ted Mortensen from Baird put it amazingly clear here in saying that generative AI is not the flip of a switch, and it's important for investors to remember that. We were able to discuss some of the earnings with him later yesterday, just after the results dropped.
Yeah, it looks like investors are on the same page as you in dubbing it Microsoft, because that's what we're seeing definitely from the stock this morning. Although, to put it in perspective, right, there was such a run-up in the stock going into the earnings here, and a lot of talk, as you and I know, going into not just Microsoft, but other big tech about the expectations being very, very high and about them really needing to deliver extraordinary numbers in order for the stock to continue to move higher. So it seems as though the assessment is they didn't quite meet that high bar.
Absolutely. High bars out there for tech. And Alphabet, one of those other companies that we've been tracking here today. Alphabet second quarter earnings beat Wall Street expectations. The tech giant reported revenue of $74.6 billion, beating expectations for the $72.7 billion. And shares of Alphabet or Google, they are moving higher, benefiting from better than expected ad performance across platforms here, driven by growth in Google Search, which saw advertising revenue of $42.6 billion, and YouTube with $7.7 billion. Julie, you listened into this call, so what stood out to you?
What stood out to me is that the executives on the call really emphasized that they are not new to AI, that it's integrated into everything that they do. Sundar Pichai, the CEO, called it their 7th year as an AI-first company, that they sort of have been focusing on that in a different way. And so it was woven into different discussions. One of the ways I thought it was most interesting is the chief business officer on the call, Philip Schindler, talking about ad tools for their advertisers using AI, being able to try on clothing in a virtual way, for example. And those are tools that they offer to their advertiser, and that was something that was successful for them. They also talked a lot about the growth of YouTube here. So it's interesting that advertising, which in other ways is seen as waning, for Alphabet is still working. The one way it's not working is in what so-called Google Networks, which is their third-party ad services for other websites. That was not as strong, but all of their sort of Google native stuff was. The other thing that stood out to me is even as the company is investing in these AI-focused areas, there is still a lot of cost discipline. And that's something that Ruth Porat talked about on the call. Let's listen to her comments.
We've been saying for some time that we are focused on revenue growth ahead of expense growth, and achieved that for the first time in some time, and that is cost of sales plus operating expense overall. And we do remain very focused on durably re-engineering our cost base.
So I thought that was interesting tonally, that they're still focusing on the cost discipline that has been such a theme. You know, it doesn't seem like necessarily that the headcount reductions are going to continue. They'll do it sort of more strategically. But I thought that was interesting. And by the way, of course, one important note about Ruth Porat, she is going to be transitioning from a CFO role to a newly created role, president of the whole of the umbrella company Alphabet, and chief investment officer. So managing the company's investments in their sort of new bets and new technologies, et cetera. And there was also a lot of sort of congratulations for her on the call, and a lot of praise of her from Sundar Pichai and the others on the call.
Yeah, I think this goes to show, especially from the analyst community that has continued to cover Google or Alphabet over the years, even in the transition for many of those analysts as well, and their time listening into these calls and having communications with Ruth, they've regarded her as an all-world CFO. And that really is what she is at the end of the day, having to make sure that a company that is as large as Google, with as many people that come into all of the divisions, whether that be into some of the consumer tech products that Google has put forward in Pixel, or whether that is in terms of some of the services that businesses rely on at the end of the day. Ruth has had to oversee all that, steer this company through a myriad of different changes and evolutions as well. And so hat tip to her, of course, and that was certainly heartfelt on the call, I'm sure. And kind of coming back to what you were mentioning within some of the growth areas that they talked about on the call as well. And I think about YouTube, specifically because we are at such a nexus or an inflection point, perhaps even, for how the screen wars are moving forward. Because YouTube has competition from everybody that's the likes of Netflix or an HBO Max or a Disney Plus, all the way into an Instagram or even a Threads or a Snapchat or a TikTok. And so with all of the shoppability that they want to move forward with, all of the creator forward features that they're trying to implement as well, that's going to be one of the next drivers of revenue, or that next leg of revenue that they can perhaps hang the hat on here. And it'll be interesting to see where investors continue to kind of hold them up to a certain standard on that regard, and some of those mechanisms and efforts too. Yeah.
Well, as we've been talking about, tech companies like Google, Meta, and Microsoft are moving fast on artificial intelligence. Alphabet is looking to lead in the AI arms race. all of them are looking to lead, but in the Google parent company's earnings call, CEO Sundar Pichai said, our continued leadership in AI and our excellence in engineering and innovation are driving the next evolution of search and improving all our services. Let's bring in Brent Thill, Jefferies senior analyst, to weigh in here. Who do you think is going to be on top here? Or is it even sort of a zero-sum game? Can everybody be winners, Brent?
Yeah, it's not a zero-sum game. It's going to be Microsoft in the enterprise and Google and consumer. And Amazon will also be a beneficiary, but more on the enterprise side with Microsoft. So 2 enterprise winners, I think 1 consumer winner, clear winner. Obviously, Meta, you have to bring into the conversation around AI as well. Anyone that's used the Instagram service knows how good the matching engines are in terms of what you're interested in. So we see it as the companies in AI that will win are the companies that have the data and the users. And those are, again, Microsoft, Amazon, and enterprise, and Meta, and Google in consumer. Those are the big 4. There'll be room for others. Oracle can benefit on the enterprise, but probably won't benefit as much. And so right now we see Microsoft as probably the clear. If you had to pick one, they are ahead of this. They started this whole AI arms race. They were the first ones to go at the beginning of the year, and they've obviously made the biggest investments. They've effectively now layered in a CapEx number that's now $12 billion higher. We were at $32 billion. Now we're at $44 billion in terms of CapEx. I mean, that is a lot of NVIDIA purchases. That's a lot of data centers. That's a lot of infrastructure they need to get ready for this AI rollout. And again, I think it's going to be phased. It's not going to be overnight. We're not all of a sudden going to move into the AI house. It's going to be a slow, steady adoption pace, and none of these products are really available yet until the end of the year in a big way. So we're going to see this as more of a 24 event than a 23 event. So again, the wave is coming, but the hype is, I think, a little maybe too strong, and you're seeing that with Microsoft stock down. Some investors felt like they would feel it more in the current numbers. Again, you can't feel it when the products aren't shipping. So we remind investors, you got to wait for the products to launch. So Microsoft's done a great job of hyping it. So we got to get these products out in the market.
With all that hype, is there any type of kind of margin contribution that you look at as AI needing to generate a certain baseline of margin contribution in order for the valuations, in order for the hype that's been put forward by companies and their executives to make sense?
So AI long-term will be very margin accretive. If you think about today, it's not. And what Microsoft guided to was flat margins for next year, which is incredible considering all the investments they're putting into AI. When you think about, there's no revenue right now really from the products. It's they have the marketing, they have the training, they have all the product development, they have the CapEx, they have everything. So basically, they've said that it's going to be the next half of their fiscal year where the revenue starts. So the entire first half is really not a lot of revenue. And to have flat margin tells you how margin accretive this can be. And then you think about year 2, year 3, year 4 in software, most of these customers, if you're an Office user, you're paying $30 to $40, $50 a user. You're not paying $30 incremental for the AI Copilot. So you're basically increasing prices by 50 to 100%. That's incredibly margin accretive. It's not like Microsoft has to go out there and drum up a bunch of sales. Like, it's going to be self-fed. The cost of sales is going to be low because the ROI is so high. They'll have inbound demand versus pushing this on people like you're at a used car sales line. That's not going to happen. So we think over time it's going to be margin accretive, and the fact that it's actually margin neutral with all these investments is actually pretty amazing to see. Obviously, Microsoft's cutting expenses other places to fuel the way for AI investments, but this is no doubt a margin accretive over time.
Brent, just to put a fine point on it, if people can't tell from how you're speaking about it, you've got a buy rating on the stock. You've got a $400 price target. So you think there's room to go up from here. And presumably you would say that maybe today's drop is a buying opportunity. Given what you're saying, do you think Microsoft needs to do a better job itself of telling the story that you are telling? You said, it's really been hyping up AI. Has it been doing it too much? Has it not managed expectations properly?
Yeah, I mean, it's a good question. I think, look, Nadella is CEO of Microsoft. They missed cloud. He got them back into cloud. He fixed their server business, their cloud business, their virtualization business. So they got back into the cloud game because of Nadella. He is not number one in cloud. Amazon is in infrastructure. So if you think about ultimately what's happening right now is, they didn't want to lose this race in AI, and they're borderline, going out in hyping. I've never seen this before, where they've hyped it so far ahead of the launch. So yeah, I mean, but they don't want to lose the war, and they want to own the narrative, and they're controlling the narrative. The callback with Microsoft last night, when I asked, I said, hey, maybe you're launching too many products. Maybe your customers are going to get confused. There's too many AI models out there. And they said, we're in hurry up offense. As they get done, we're going to unleash them. So this is, they're not going back to the huddle. They are literally on the line, ready to roll, and they want to plow everything over in front of them. In football analogies, they are ready to roll, and they are not going to hold back. And they do not want to lose to Google, or they do not want to lose to Amazon, because they lost that cloud war to Amazon out of the gate. They're not going to lose this one.
All right, very much a Seahawks with Marshawn Lynch days type of strategy that they're employing then, I suppose, deeper into the football analogies. But I guess pulling back from those, let's talk a little bit more about Google, or Alphabet here this morning too, and their earnings. A different strategy perhaps, but at the same time, there's certain parts of the business where they're going to hope to leverage AI and lean into that. Where do you think it's going to be immediately evident that they're having success with their own artificial intelligence efforts?
Well, I think they're having it today. I mean, he pulled an LL Cool J, don't call it a comeback. We've been in AI 7 years. And again, I use the analogy for any consumer. Jump in your car and go to work on Waze. It's not Judy or Joe telling you to turn left or right. It's the AI engine that's telling you where the traffic is, right? Turn on YouTube TV, and in the morning it'll tell you, are you interested in your local news or ESPN or some other show, right? It surfaces the content you want right in YouTube TV as you turn it on. When you do a search and look for a restaurant or look for this is infused with AI already today, and I think this is the point, which is it's infused today. And if you look at their spend, Microsoft had to take their capex from 32 billion to 44 billion. Google didn't really bring their capex up in a material amount because they've already been investing. And so what I've said is there's so much technology inside Google that we can't see. They're going to unveil, and I think we're all going to be blown away. As some of the top computer scientists that we've interviewed that teach at Stanford and have been part of Apple and other major tech corporations, they're like, this is crazy that Wall Street doesn't think they have good AI. They have better AI, and they've contributed more to AI than anyone. So we have a situation where Wall Street's like, Microsoft's going to crush them in AI. Their bar demo blew up. Short Google. That's wrong. And that's why Google stock's going higher, because investors are underweight Google because they think they're going to get run over in AI, which is not true. This is not a zero-sum game. They're both going to win. And Alphabet is underappreciated for AI. And I think, again, they mentioned it 52 times in the prepared remarks. 52 times. And that wasn't even in the Q&A. Okay, it was more than Microsoft. And that tells you that they're upset, and they're not saying this, but I got a sense they're not happy with how Wall Street's treating this or Main Street's treating this. And they're going to be clear what they have. And I think we're all going to be shocked. Stock's going higher.
Yeah, I picked up on that a little bit at the end of the call when Philip Schindler was asked a couple of questions about how they're incorporating AI into tools for advertisers. And he said, well, I did talk about that earlier on the call and gave sort of details about how it's being incorporated. Brent, I do want to ask you another question that's very important about Alphabet, and it has to do with Ruth Porat. Obviously, she's getting this big new role. Are they setting her up to be CEO eventually?
Absolutely could be. And I think that, she did a fantastic job on the buyback. She brought the buyback to Google. They've been leaning in. They've been buying the stock back. I think investors have been disappointed with their investor friendliness. If you think about Microsoft giving guidance and more color and doing calls and being really transparent and bringing people on campus, I mean, Microsoft has done a phenomenal job. And I think that investors want more, institutional investors want more out of Google. So I'm hopeful the new CFO that comes in can give a little more color and analysis. We didn't maybe get that. I think operationally she did a phenomenal job and well-deserved, and super happy for her. So yeah, I think it seems like from an operation perspective, it sets her up for better things ahead.
Brent, while we have you, let's pivot to one other company that did report earnings and has seen investors react, but quite negatively here, especially after the earnings dropped. Snap, ultimately, just some disappointment from the street that is evident in the stock price reaction as it moved lower by about 17%, still lower here this morning by about 18% here. Just want to get kind of your general take on what the company had to say, and if this is a company that still is worth investors kind of holding or kicking the tires on at all.
We don't have a buy on it, as our team has covered this. I think it was the disappointment in the operating expenses, obviously coming in, and the losses that they're seeing. And I think ultimately, I've said this repeatedly, when we poll teenagers and younger audiences, most of them are using Snap because they don't want their parents to see their instant messages. They use the messaging platform, but they're not influenced by the content on Snap. They don't see an ad and then convert. They don't have the money. The parents have the money, right? And so ultimately, I think this has been a younger audience tool. It's been a communication tool, but they're not able to monetize the users the way that they should. So there's an incredible viral adoption of the younger audience that loves this. They can see where their friends are on the map. They can message. They haven't monetized it. So this is an opportunity where you have the users, but you don't have the money. And ultimately, they need to fix that. And again, I think this is a long road back.
And I'm curious where it ends, Brent. Two final questions on Snap. 5 years from now, one, does it exist as an independent company? Two, does it exist at all?
I think right now there's a lot of questions. I mean, TikTok and Meta with Threads is really taken over, with Threads and Reels. And so I think when you start to think about there's been some share that's been stealed away from them. So do they need a partner? Do they need to be acquired? Is there some other roadmap that they need to go to, playbook they need to go down? I think they're clearly showing that that's the case. I mean, there's financial stress here. So when you have financial stress and you're not benefiting relative to others, you got to look at alternatives. I don't know the exact alternative, whether it's a partnership, an acquisition, but they've got to do something different because it's not working.
Brent Thill, Jefferies senior analyst, thanks so much for joining us this morning, and we're going to let you go before that sun rising in the east starts to hit your eye. We want you to be safe over there. Thanks so much, Brent. All right, guys, switching gears, artificial intelligence maintaining its status as the top buzz term this earnings season. This comes after 7 big tech companies signed on to commit to safeguards in the industry at the White House's request. Alphabet CEO Sundar Pichai had this to say about plans for AI safety in the company's earnings call last night.
We are making sure we develop and deploy AI technology responsibly so that everyone can benefit. Last week, we signed on to joint commitments with other leading AI companies at the White House, building on the principles that have guided our work for many years.
So joining us now, we've got Navrina Singh, who is the Credo AI founder and CEO. Great to have you here with us this morning. When you think of a commitment like this, as talked about by a few of the tech CEOs and heard there from Sundar Pichai, what comes next in terms of not just saying we're committed to this, but also making sure that, I don't know, there's enforcement of it, or there's some governing body that makes sure that all of these different companies are acting within the terms that they've signed on to?
Thank you so much for having me this morning, Brad. At Credo AI, we are making sure that AI is built not only responsibly, but is deployed safely across all the applications. And we do so by providing an AI governance software that is used across Global 2000s, SMBs, and startups to ensure that we are managing, monitoring, and mitigating AI risks. So we're very excited to see these commitments from some of the top foundation model providers. But as you said, I think all eyes are on what's next. And a lot can go wrong if not done right. As an example, there's a commitment from the Biden-Harris administration around an executive order, which is going to be tied very closely to these commitments. So right now, there is a lot of motion in the administration that we are very excited and encouraged by. However, what is part of that executive order is what's going to matter. The second thing is, how are we going to measure these commitments and how these companies are upholding themselves to those commitments is the next thing that we are very carefully watching, because that's where, the rubber meets the road.
And what is the history in this department, not on the part of governments, but on the part of corporations when it comes to, obviously, this AI focus is new, but other new technologies? Do they have a good track record?
Yeah, so Julie, it's interesting. AI focus is actually not new, but right now what's happening is that there is a renewed focus on generative AI, and there is a race to see who is going to win and control the narrative. So in terms of what we can learn from the history, we've seen similar situations with GDPR, privacy as a key example. And then one of the core things there was that the companies who came out on the top were the companies who actually not only invested in it, but actually made sure that privacy was central to their business. So I think a lot is yet to be seen in responsible AI and safety, and how these commitments are being actually acted on by these large AI providers.
Why was something in the form of a commitment like this not put forward earlier? I mean, we were just speaking with Brent Thill about why, for Google, they don't have to talk about ramping up their investment and their expenses aren't skyrocketing higher like some other businesses, because they've been investing in it for so long. If you were to ask IBM, they've been deploying AI and advertising it for the better part of 2 decades now, since I was in high school. So you think about the efforts towards AI that have been out there, and now all of a sudden it's different because of generative AI. So why wasn't this the case before?
Yeah, absolutely. AI, the innovation in artificial intelligence has sort of scaled very rapidly. And we are seeing that with generative AI, especially the foundation models, there is rising concern around the emergent properties of these artificial intelligence systems, which, if not managed appropriately, could actually result in massive risk to humanity, to countries, to companies. But I think, let's pay attention to the 2 core narratives that's happening. One is most of these companies are recognizing that generative AI is their next Trojan horse in the business. And if that is the case, as we heard from Brent previously, most of the companies are plowing ahead. And since they are plowing ahead, they want to control the narrative. And when you're trying to control the narrative, it becomes really critical to own the entire spectrum of what from product to safety looks like. But the second thing is these emergent, capabilities of these AI systems, if left unchecked, could really have massive consequences. So the reasons we are seeing these voluntary commitments, increased focus on regulation, is because now the multi-stakeholder ecosystem is coming together to make sure that we have guardrails in place, not only for business success, but also making sure that the consumers get the benefits of this powerful technology.
Navrina, thank you so much. Navrina Singh is Credo AI founder and CEO. Appreciate it. Shares of Gap are jumping this morning after the retail company finally announced a new CEO. It's former Mattel executive Richard Dixon who is taking the helm. Yahoo Finance executive editor Brian Sozzi joins us now to discuss. We have talked about this for so long, Soz. Who could possibly lead this company and turn it around? Many have tried,
yes,
without success.
And many have failed.
Yeah.
This comes at a very interesting time for 2 different reasons. First, for Gap's perspective, what better time to tap the person that essentially saved Barbie twice in Richard Dixon off of this really blockbuster opening for the Barbie movie. So they get a lot of hype. Probably gives Richard at least 6 to 8 months to build his team, get in there, really get into the trenches. Now, he joined the board in November last year, but really operationally get into the trenches and start to build and improve his management team and reinvent or try to just reboot that culture at the company. But then also, too, from his own perspective, Brad, you and I just talked to Richard at Cannes about a month ago. He was there in Mattel capacity. I just saw him at the premiere a week ago. I did think it was interesting he wasn't on the stage with Mattel CEO Ynon Kreiz. I Thought it was a little strange at the time. Maybe now I know why, in fact, that was the case. But for him, he can't do any more at Mattel. This is his Michael Jordan moment. He is leaving on top. He reinvented the Barbie brand twice. He brought it back to life, increased diversity, inclusion with the brand. Now he has this movie. That is his, I think, just swan song at Mattel. But look, we've covered Gap for a long time. It's a stock I used to cover as an analyst, probably. I've been watching this company for 20 years. They've never really gotten anything right. And the stock is down about 70% over the past 5 years. They've lost considerable market share. Many people hate going in the stores. The fit continues to be a problem. The clothing is boring. And then, oh yeah, this is also a company that in 2020 pulled back from breaking itself up and splitting itself and getting rid of that Old Navy division and splitting it off into a public company. So look, Richard Dixon, visionary type of leader, has a proven track record of success, but he is going into the company with deep, deep fundamental problems.
I'm changing my my Slack avatar as we speak to our photo with Richard Dixon from that interview a few weeks back. But you know, when we think about the first 18 months for Richard Dixon stepping into this role, what do you think needs to happen?
First playbook, I think he just needs to start rebuilding the culture of Gap. This is a company that has laid off thousands of human beings over the past 5 years. Most recently, 2,000 layoffs a couple months ago by Bob Martin, longtime chairman of the company, but has been the interim CEO. So he needs to reboot that. And there we are, Richard, me and you, Brad, and Cam, right on there, here in France, working very, very hard against that backdrop of very blue water. So that was Richard Dixon talking about Mattel and his Barbie movie. But look, he needs to reboot the culture, and then he needs to really, I think, get visionary type of leaders to lead each division. I would not be surprised if the current existing CEO of Gap leaves and leaves soon. I am sure he would have thought he would have maybe gotten this job in some capacity. He's been there since 2020, leading that division. I think he just needs a complete reboot of the culture, complete reboot of the management team, and let's see what he can do.
They did just hire a new person to lead Athleta who came from Alo Yoga, which I thought was interesting. I'm just curious, someone who is at that point in their career, then sort of diving into what has been the black hole of the Gap. It's going to be,
there's nothing more I think a lot of certain execs want to do than come in and they have a vision of turning around a storied enterprise. They have this vision that they can come in and in 2 to 4 years, they have engineered this amazing turnaround and fixed a company that has been broken for 25 years or whatever it is. And that's very alluring and very attractive to a lot of executives. Whether Richard could do it, unclear. But if there's anybody that is finally going to do it, it is Richard Dixon. But again, this is a retail industry that is extremely competitive.
Yes.
You know, I look at the other side of the mall, and Abercrombie & Fitch completely reinvented, selling cool stuff. I think he has to do the same here.
Well, as a long-time, one-time Gap customer, I'm rooting for them as always. Thank you so much, Saz. Appreciate it. Well, we had the opening bell on Wall Street, so let's do a quick check of the market, sponsored by Tasty Trade. Obviously, a lot of earnings news today that we have been considering. The Dow trading slightly lower here. The Nasdaq really taking the brunt of it because of Microsoft, basically, because of those disappointing numbers to some and the slump we're seeing in the shares. Brad's over at the Interactive breaking it down for us.
Yeah, I am. The Dow Jones Industrial Average right now, let's put this on a, we moved it over to a different view here. Let's just put this on a chart view for the folks at home here. Taking a look at the Dow, out of the gate, flat just barely to the upside. Nasdaq Composite, you're seeing that to the downside by about 0.3% here for the tech-heavy average. And the S&P 500, that's also in negative territory by about 0.2%. I'm saying that as the Dow also, given the fact that it was flat, it was carrying a high propensity to perhaps slip into negative territory. It did just that. So we've got all major averages, at least as of right now, out of the gate in negative territory. Let's take a deeper look at some of the sector activity just to give you a glimpse of where things are moving and shaking out of the gate this morning. You've got some of the communication services names catching a little bit of a bid. That's up by about 1.5%. We're going to dive more into one of those names that is within that sector. XLK, though, technology, that's pulling up the caboose. It's down by about 1.25%. We are mixed right now, but it looks like you've got more laggards than gainers. Let's take a look at that tech-heavy average, given that we were breaking down some of the mega-cap tech companies' earnings that dropped yesterday. And oh yeah, none more so than Microsoft and Google. Taking a look at those differences in moves that we're seeing on the day. Google or Alphabet coming off their earnings up about 5%, 5.4% as we begin today's trading activity. Microsoft, on the other hand, though, the brand of Azure, that's down by about 3.5%. So we'll continue to keep a close eye on that. Also keep an eye on Meta. Of course, they're reporting earnings this week as well, and that's down by about 1.4%. And I wrote down one word on, well, a couple more than one word on my little notepad here, and it's Fed. Fed is going to be, and some of the yields are going to be interesting to watch today as well. So I'll just ride out with a look at that as we kind of scroll down and see exactly where some of those notes are. And as of right now, we are down pretty much across the board right now, Julie.
Interesting here. Yields pushing lower as people maybe bet that this is the last rate hike that we will get today. We shall see. All right, we got much more markets action coming up ahead, including movers. You're watching Yahoo Finance. It's a very busy week. We got the Fed, we have a lot of big tech earnings, a lot of earnings period. Will it provide the clarity that we need for the market?
I think in terms of the macro data, it's still going to confirm the soft landing narrative. I don't think any of the data we get this week will really change that. I also don't think the Fed's going to rock the boat too much. We'll have to wait either to Jackson Hole or the September meeting to get any kind of clarity on the rate path ahead. Which brings us to the most important thing of the week, which is the micro earnings. And specifically tech earnings and question marks around both the top line as well as the margin outlook for tech. Given how powerful the rally has been this year, it's really crucial for those earnings to beat expectations.
Among our many earnings movers today, AT&T, the share's down about 1% after the company's cost-cutting efforts and 326,000 postpaid phone subscriber additions helped boost the company's free cash flow for the second quarter, but obviously that wasn't enough to boost the shares here. Free cash flow, it says it's going to reach this year of $16 billion, so reiterating that target here. The customer additions, though, that I mentioned, 326,000 was actually lower than anticipated, so that might be part of what's going on here.
Yeah, and they're also kind of committing to this incremental $2 billion plus in cost savings beyond the $6 billion that they have accomplished over the period of time, reflecting a march towards operating the company in a more focused and streamlined fashion. So adding on to some of the cost savings that they're looking to put forward here, it'll be interesting to see in what parts of the business they're looking to trim some of those costs there. But then additionally here, you look at the revenue base, the consumer broadband revenues, that was up 7%. They're saying that that was driven by AT&T fiber revenue growth of 28% there. They also saw about 251,000 AT&T fiber net adds. Just to put a number on that gives them about 14 straight quarters with more than 200,000 net additions in that part of the business.
Yeah, and the company, I'm just looking at some of the commentary from the conference call here. The company says CapEx is going to be $1 billion lower in the second half of the year. They are enacting some changes. They're going to cut down on headcount. And then finally, an issue that we have been monitoring, spurred by that in-depth investigation in the Wall Street Journal into buried lead cables, not just by AT&T, but by other telecom providers. AT&T did say last week in a court filing that less than 10% of its copper wire network had lead cladding for it. So, that's something to continue to monitor for these various big telecom companies.
Also, continue to Command F or Control F for anything mentioned around delinquencies as it relates to customers and just paying bills on time. That's something to pay close attention to, that we've been able to continue to question some of the company's leadership about just what they're seeing in some of those engagement levels.
We are also watching shares of Coca-Cola after the company saw sales rise 6% in the second quarter. It also raised its full-year outlook. Yahoo Finance's Brooke DePalma is here with us on set with the details. So what's going on at Coke?
Well, right now, Coke coming in, beating on both the top and bottom line as consumers continue to not push back to higher prices that they've taken last year and this year. Revenue coming in at $11.9 billion, beating Wall Street estimates and driven higher by those price increases. They increased prices by about 10% this past quarter. Of course, they were taken in part due to higher commodity costs like the cost of sugar, but consumers not pushing back. Volume remaining flat in most markets, but one bright spot there, Coca-Cola Zero Sugar spiking 5%, reflecting strong growth in Latin America as well as North America. Here in the U.S. and North America overall, volumes actually declined by 1%, dragged down by declines in water like Smart Water, sports drinks, and Powerade and coffee. All of this, as you can see, just giving Coca-Cola executives the reason and the opportunity to raise their full-year guidance up 5 to 6%. And in terms of revenue, they're also raising their growth outlook there to 8 to 9%. And CEO John Quincy on the call saying that really revenue growth is driven by three buckets: the impact of the carryover of prices taken on this so far this year, and in addition to that, they're really seeing a little more inflation that they had expected so far this year, but they do expect that to sort of moderate as they cycle out those price increases taken year over year. But shares of Coca-Cola not really moving too much here, most remaining flat, but it is a trending ticker on YahooFinance.com right now.
Why aren't the shares I mean, the picture that you painted sounded pretty darn good.
Pretty optimistic, right?
Yeah, why aren't the shares doing better?
Yeah, well, in addition to that, I mean, they are losing some share to private label. They did mention that. That's happening in both Europe and the U.S. They're seeing that in water and juices, but they're seeing less of that in terms of Coca-Cola. So maybe analysts holding on to that. But as I noted before, in addition to that, they're also really, taking the opportunity to promote, to add to seeking value. Of course, consumers right now looking for those deals. And so they're really trying to play into this promotional value environment. But analysts right now, the call did just wrap up about 10 minutes ago, so perhaps we'll see shares move later on today.
All right. We'll keep a close eye on that price reaction. Thanks so much, Brooke. Appreciate it. Also, shares of Boeing flying high today after the company saw losses narrow in the second quarter and showed a boost in aircraft deliveries. They're taking a look at shares of BA up 6% on the back of this earnings report here. A few other things that we've been tracking with regard to Boeing here, as the investors are clearly liking what they saw, at least coming out of this second quarter here. They mentioned that revenue increased, primarily reflecting 136 commercial deliveries here. Now, they also are transitioning 737 production to 38 per month. That increased 787 production to, and then also increased the 787 production, I should say, to 4 per month there. So both of those had been two of the airliners, or the aircrafts rather, that were in investigation, or at least had more FAA scrutiny as of recent years, and moving through some of those issues there. Boeing continuing to bring back up to speed some of that production capacity as well.
Yeah, the other key number for Boeing besides production is free cash flow. Yeah. And there it also beat estimates, $2.58 billion. That's what the company did. Analysts were predicting that they would have a cash burn, so not free cash flow at all in the quarter. So that's a big surprise, and I think also something that is helping the shares in today's session.
Absolutely. Well, we've got all your markets actions straight ahead. We'll continue to watch all these tickers, and we've got a few more for you here coming up very shortly. You're watching Yahoo Finance.
Inflation has been good for profits. Will disinflation be bad or be good for profits?
So far, we seem to be in a sweet spot where input prices are coming down at the same time that companies are still able to raise prices for their end consumer. Let's see how long that lasts. The question is, are margin expectations realistic for the second half of the year? They're quite high, so it's quite crucial for the earnings outlook in the second half and into 2024. Pricing power is going to be important, meaning it depends on the company.
I'm Dan Howley, and we're here in Seoul, South Korea, and we are checking out what's new from Samsung. This is the Galaxy Z Flip 5, and this is the Galaxy Z Fold 5. We're looking at two foldable phones. Let me just show you a little bit of that. Boop, nice and flat. Boop, nice and flat. And that nice and flat is part of the reason why Samsung is updating these new phones, because they're able to do that with their newest hinges. It's also important to point out that the Flip, which I've seen a lot of in South Korea, has this nice big new screen up front, and when you run through it you can do different things, check out your weather, check out your appointments, check out everything along those lines. This is probably my favorite device that we're seeing here. This starts out at $999 though, so it's a bit pricey. Then we have the Z Fold 5. This is going to be a lot larger. You have this big front screen here where you can see all of your apps, basically do whatever you want that you would do on a normal phone. But then when you want to game, when you want to watch some movies, if you want to browse the web, yahoofinance.com, you can open this bad boy up, and then boom, that's a much larger display that you can get there. But this is also pretty expensive. We're talking $1799 for the starting price. So very pricey. A lot of people might not be able to afford that. The key differences here is obviously, besides the orientation, the different types of cameras we have. We have telephoto, wide lens, ultra wide. On here we have a wide and ultra wide. But I do got to say, I really am enjoying the Flip. And as I said, I'm seeing them everywhere. I've seen a few folds, but Flips people are carrying around all over the place. Right now we have competitors from Google with their own Pixel Fold. We have Motorola with the new Razr Plus. We also have a number of Chinese companies making foldable phones. The big one that's not in the race yet is Apple. We'll have to see what they do in the coming years if they're actually going to roll one out. But for now, Samsung seems to have a really good head start with the Z Fold 5 and the Z Flip 5.
Yahoo Finance's Dan Howley. They're getting a look at Samsung's next generation foldable phones as it's at its Unpacked event in Seoul, South Korea. The big question is, the return of the flip phone going to take hold in a serious way beyond that nation? And will we see flip phones from other phone makers like Apple, for example? Joining us for this discussion, Ramon Lamas, who is IDC Research Director for Mobile Devices and AR/VR. So, Ramon, are we all going to be holding flip phones a year from now, or do you think that this is the sort of killer product that's going to convince wider adoption?
You know, I was listening to Dan talk here and listening to him say, yeah, I'm seeing this flip device all over the place in Korea. But guess what? That's Korea. If we spread this out worldwide and we take a look at that entire market, you're really just looking at that, you know, foldables are accounting for about 1% of all smartphone shipments worldwide. And when you're looking at a market of about 1.2 billion smartphones being shipped each year, that's still a really small percentage. It's still a small number, but here's the good news. It's growing. Okay, but for now, I think it's going to be going towards a lot of, you know, niche segments instead before we reach to that mass market. We still need some time. Okay,
but this price point, I mean, I think that took both Julie and I by surprise here as we were just sitting thinking about how much some purchasers out there are going to have to pony up at a time where we're already kind of thinking through where we're at within the phone or the kind of smartphone cycle for buyers out there.
Yeah, this is not an inexpensive device. Let's get that straight out. And again, you know, this is really going to be for a very niche segment. And for me, that niche segment is going to be your smartphone power users, your, you know, content creators, your, you know, multitaskers, people who really live and die by their phone. Okay, and this is gonna be seen as a not really so much a nice to have and an interesting thing, but it's gonna be a must-have type device. So, you know, when you take a look at those price points of, you know, $1799, which for a lot of people is you know, gonna be out of reach, you know, let's spread that cost out over, you know, 36 months, which is what a lot of carriers and retailers are doing right here in the United States to make that just a little more palatable. Now, that's still gonna be a lot of money. There's still a lot in terms of, you know, monthly payments. But, you know, it's not, you know, for everybody, it's not going to be all $1799 up front.
Is Apple going to make one of these? Is Google going to make one of these? Who's going to make them stateside?
Let's talk about Apple for a minute, because we get that question, you know, pretty often. Apple, I don't see it happening now. I don't see it happening, you know, in the, you know, near future. But take a look at what Apple does. Apple waits and takes a look at what happens in a market before it really makes a move and says, okay, we're going to join. And you've seen that before. If you remember back in 07 with the first iPhone, when it just had about, a 3.7-inch screen, that was more or less the standard. It wasn't until, companies like Samsung came out with their phablet devices where you had, a 4-inch, 4.5, 5-inch, display. That Samsung said, that Apple said, yeah, you know what, that's something we're going to get into. Okay. And they did, and they have. And Google, actually, they just announced it, they at their own event back in May, that they're getting into it as well. You can actually get it on their website. So I think, if we look at Apple, it's going to be a wait and see because their strategy is, has been for a long time also. Stand on the shoulders of the giants that's come before them to prove that there is a market here for this. And then we'll look at it a little more seriously. And I think a lot of other vendors may be feeling the same way.
We've been keeping an eye on your smartphone shipment tracker as well. And for IDC, you had in the first quarter that we had a 14.6% drop in the first quarter of this year of smartphone shipments. Where are we at as we've moved through the second quarter and are now kind of looking at the forecast for the back half of this year too?
But the second quarter has always been a time of, kind of a lull in the action. I mean, first quarter is usually that, the coming down from that, very busy fourth quarter. So I'm not expecting, too much, growth taking place. I think as we get into, the second half, the third quarter and the fourth quarter of the year, by and large, those are going to be, the busiest times of that mobile phone market, coinciding, not surprisingly, with a lot of the new devices coming out. So, first for us, I think it would be, kind of conservative in terms of, what that, full year-over-year outlook is going to be. But when you get right down to 1.2 billion smartphones, there's still a lot of smartphones out there, and there's a lot of space for a lot of different vendors to play. The question is, which spaces do you want to play in? Look, with Samsung today, they're really cementing their position in that ultra high end of the market. Apple is also there, but you know what? That's a rare stratosphere for many other vendors. So let's wait and see what happens next.
Since you mentioned devices as a whole, do you consider a headset a mobile device, and where would that fall in your coverage? How does that kind of fit into this broader equation of where consumers are going to be engaging with devices as a whole?
I think with you mean a handset like a mobile phone? That'll be a mobile device. But if you're talking about headsets like AR and VR, these things have been, mostly stationary, like say, your Meta Quest 2 or what you saw with the Apple Vision Pro. But you know what? I think when we take a look at that kind of category specifically, it's still very early days as to what is taking place. Now, are you going to see people walking down the street with these devices on their heads? Probably not. But I would bet, in 5 years and in 10 years' time, these are probably going to become more ubiquitous and more commonly seen. So it's not just like one person, showing off to a bunch of friends. It's going to be a bunch of friends, getting together virtually to experience, a shared experience, whether it be watching a movie, watching a sports event, or watching some other major event. Let's just say something like, say, Samsung Unpacked, where you're not just seeing it on a two-dimensional screen, but you're actually sitting in the audience, you're sitting in the crowd, and you're getting that feeling of what it's like, to be there. Now, if I could just switch gears a little bit, for headsets, for these, it's these things are trailing far behind smartphones. We're still very much in early innings, so let's give it some time to grow up and mature.
Yeah, definitely. Until I can, comfortably have a silent disco with my friends somewhere with my headset, I don't think I'll be doing that anytime soon. Ramon, thanks so much for taking the time here with us today. Ramon Lamas, who is the IDC Research Director for Mobile Devices and AR/VR. Appreciate it.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
You just got married. Can you tell us what your favorite present was that you got?
Oh, I can tell you what my husband's favorite present was, which was an ice cream maker.
Oh, that's a good one.
So we've got gelato tasting on tap every weekend.
Wow. So you not only is it the favorite present, but you actually have used it a lot.
Well, once, but they're big
classic
plans.
Is that you get the amazing present and you're like, wow, this is great. And you use it, and then it sort of fades and use.
We'll have to see. TBD.
Okay. We'll check back in on that one.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live, and I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into the trading day, so let's take a look at how stocks are moving right now. Wall Street eagerly anticipating the Fed's outlook here. Stocks lower as investors await today's FOMC decision. The Fed is expected to raise interest rates by another 25 basis points, with most projecting this to be the final hike of the Fed's cycle.
Now let's look at some individual stocks. Tilray climbing higher and then some, up 25% today after reporting a narrower than expected fourth quarter loss at just 15 cents a share versus a loss of 99 cents a share a year earlier. The cannabis company also saw revenue grow 20% to a new record high. The stock has suffered year to date as the cannabis industry at large remains under pressure.
Shares of Union Pacific jumping this morning after the company names veteran rail executive Jim Vena its new CEO. This comes after major shareholder Sarabande Capital Partners called for current CEO Lance Fritz's removal, saying the company underperformed under his leadership. Vena previously served as Union Pacific's chief operating officer from 2019 to 2020 and will take his seat as CEO August 14th.
We're also watching shares of Chinese EV maker XPeng. The stock is soaring today, 36%. That's on news that Volkswagen plans to invest $700 million in the company, and then they plan to jointly develop electric vehicles in China as VW looks to grow share in that market. Volkswagen's eventually going to hold almost a 5% stake in XPeng via a capital increase and is also getting an observer board seat. So obviously XPeng investors very enthusiastic about this news. We're also enthusiastic about some breaking economic data that we're getting. New home sales for the month of June falling 2.5% month over month to an annual pace of 697,000, and the month earlier got revised lower as well to 715,000 from an original read of 763,000 here. And this is high stakes right now because, as we've talked about, there is not enough supply in the existing home market. There is demand out there to some degree, and economists were looking for new homes to sort of try and make up some of that demand, but it's interesting that we're not seeing that sales pace up to snuff.
Yeah, it's been interesting, especially with some of the other home data that we've seen come through. S&P Case-Shiller data came through on the homes front yesterday, and particularly interesting where there is still some pickup, at least in certain regions, and where in the Rust Belt particularly, there is more of that propensity or more of that demand. But even as we're looking across prices or where the sales are taking place, I think it's one of the larger sticky areas of inflation that the Fed still is looking at to continue to watch and track to see when there is some abatement in the number of bids and the price as well, that consumers are still willing to bid into, knowing that rates are higher and that financing is going to be more difficult over an extended period.
Sorry, and speaking of price, the median sales price of new homes sold in June, $415,400. The average sales price was $494,700. So obviously that number more gets pushed up by the higher end. But interesting here, supply right now of new homes, 7.4 months at the current sales rate. That has been creeping higher and higher as we have seen inventory increasing. So going to keep watching these housing market numbers very closely. And we're going to be talking, by the way, to a guest in the construction industry coming up a little bit later, not on the residential side, but still a bigger look at real estate.
For sure. Looking forward to that conversation. Plus, looking forward to what the Fed has to say. Fed Chair Jerome Powell, my goodness, Super Bowl type day for him. The Fed is expected to raise rates by 25 basis points this afternoon, bringing the target rate to a 22-year high. Joining us now to break down this is Yahoo Finance reporter Jennifer Schonberger. Jennifer, great to hear from you. Great to see you. I mean, I got to imagine Fed Chair Jay Powell wakes up this morning, pours himself a fresh pot of coffee, and he's ready to go. He's rearing to discuss this with his FOMC members.
Hey there, Brad. Good morning. Great to see you as well. Indeed, officials about an hour into the second day of their two-day policy meeting here in Washington, where they are widely expected to raise rates by another 0.25 percentage point and keep the door open for additional rate hikes later this year. Take a look at those Fed funds futures this morning. They are pricing in nearly a 100% chance of the Fed raising rates by 25 basis points this afternoon. Now, a 25 basis point rate hike would mark the central bank's 11th rate hike in nearly a year and a half after taking a breather in June. It would take the benchmark interest rate, the Fed funds rate, to a range of 5.25% to 5.5%, marking a 22-year high. With no new interest rate projections or economic forecasts released at this meeting, all eyes will be on Fed Chair Powell's press conference and the outlook for monetary policy. Powell is likely to talk tough on inflation and suggest another rate hike in September could be possible to avoid loosening financial conditions. Wilmington Trust Chief Economist Luke Tilley telling me, I think that they'll still need to talk a little bit tough and hawkish. They need to acknowledge the CPI data, but also talk about risks because they don't want financial conditions to ease up. Now, last meeting, officials penciled in 2 more rate hikes for the second half of this year based on higher expectations for core inflation. The Fed now expects inflation to end the year closer to 4%, up from 3.6% previously. That would be nearly double still, though, the Fed's 2% target. Of course, an interest rate hike this afternoon would mark the first of potentially 2 more rate hikes this year. Guys, this interest rate decision coming down at 2 p.m. Eastern, followed by Fed Chair's press conference at 2:30 p.m. Back to you.
Look forward to your coverage from there, Jen. Thanks so much. Appreciate it.
Thanks, Joy.
It is indeed decision day for the Federal Reserve, which is expected to raise rates by another quarter point at today's meeting, bringing the target rate to a 22-year high. This is going to be the 11th hike in the cycle. It's expected to maybe be the last, depending on who you speak to. One of the people who is expecting that is Julia Coronado, Macro Policy Perspectives founder and president. Julie, good morning. It's good to see you. So you think this is going to be the last one. Why?
Well, as you noted, the Fed has a forecast of core PCE inflation close to 4% this year in Q4 of this year. And that's just much higher than the data are tracking. So by the September meeting, they're going to have 2 more inflation prints in hand. It's going to be very clear that that forecast is overly pessimistic, and they're going to have to lower their forecast. So remember, they took a pause in June. That was, Chair Powell described that as slowing the pace. So we're going to hike today, and that means the next hike would be slated for the November meeting. But by September, it's going to be pretty clear that inflation is tracking lower. It'll be the first downward revision in their forecast in a long time. It'll still be running above their target, but at least it's moving in the right direction, which suggests it's time to shift to the next phase of their strategy, which is just higher for longer. They don't need to keep raising rates, just hold them at a higher level. Apply that restraint on the economy, let inflation move lower gradually, and then over time you can start cutting rates. That's the phase we're entering, we think, fairly soon. Okay,
and so if entering that phase fairly soon, by when or how early could we see some type of cut from your perspective or estimation?
Well, that's, again, barring a recession, which we do not have a recession in our baseline. If we go through a period of sort of trend to below trend growth with inflation gradually moderating, the Fed isn't going to turn around and cut anytime soon. We think that they'd like to have a 2 handle on the core inflation annual reading, so core PCE inflation dipping below 3%. We have that happening at the end of Q1 next year, early Q2, which means the earliest we see the Fed cutting, barring a recession, is about the May 2024 FOMC meeting.
Julia, first of all, do you think we're actually going to avoid the recession entirely? And secondly, how? Because it does seem like it is anachronistic, right? This current setup and environment and what we've been seeing.
Yes, it's been a very unusual cycle. And one thing that's been a huge headwind for the economy is just the operational frictions that have come with the pandemic, both the shifting demand, the supply chain frictions, the super elevated labor turnover. All of these things have made it hard for businesses to do business, to run their operations efficiently. We think we're right now in the early stages of a productivity dividend. So yes, top line growth has slowed. We are seeing a mild earnings recession this year, but it's not particularly severe because there are these offsetting tailwinds from lower labor turnover, from better supply chain functioning. And that's a unusual tailwind at this stage of the cycle, given and very particular to the pandemic recovery, that we think will help us kind of offset that tighter policy. Also, fiscal policy is going to be a moderate tailwind. Again, not a massive stimulus, but we do have a positive impulse coming from both state and local and federal governments, which is the mirror image of what we had last cycle, where it was a constant headwind for years. Now we've got a modest tailwind, and that again helps the economy be more resilient.
What could the Fed come out and say, and Fed Chair Jay Powell come out and say today that the markets might continue to look at and say, you know what, this is still all systems go with the move that we've seen in the past month for the S&P 500 up by about 5% over that time, that there still is more legs to this, especially if there are certain parts of the commentary that signal that everything is still looking good and soft landing is still very much the classification, or perhaps we just keep flying. Perhaps that's what they come out and say, even though they haven't necessarily leaned into our plane analogy as much as we want them to.
I don't think that Chair Powell wants to further stimulate the stock market rally. That tends to be something that he sees as providing a little bit of a boost to the economy and making their jobs harder. I don't think we are in the phase where the Fed is micromanaging the stock market. And I think what Powell is going to remind the market today is that a soft landing also means higher for longer interest rates. If we skirt a recession, then there is no reason for the Fed to turn around and cut anytime soon. So soft landing also equals higher real rates. And that might be something that the market isn't putting completely together. We've gotten some relatively less bad news than expected on earnings. It's still not an earnings boom, nor is it an economic boom. Growth is running around trend. So it's not like all systems are go and we're entering a growth acceleration. And I think as the data, continue to paint that picture, that reality is going to be something that the market has to absorb. I think the new home sales data this morning are a good example. There's been sort of talk about a housing rebound. There is no rebound. Housing demand is bottoming at a fairly low level, given much higher interest rates. We do have a supply problem, and that has kept prices from correcting more. But it's not like home sales are going to be surging upward anytime soon, given that rates are going to stay high for a while.
So how long do you think we could stay at the bottom here of the housing market and kind of bump along?
I think for some time. I mean, we know that there is demand sort of from a demographic perspective. There is demand for housing, and we haven't built enough supply. So it's not like we need a major housing recession. But again, housing is more expensive. Affordability is a real issue. So between higher rates and lack of supply and homes that have appreciated dramatically over the last couple of years, the numbers just don't add up for a lot of people, and home ownership will be constrained for those reasons.
Julia, finally, I want to ask you about the bank deal that we heard about today, because obviously the banking industry has been such a source of focus for the Fed. PacWest being bought by Bank of California, they're getting some financing, some private equity financing as well. This implies that the sort of stress in the banking system was not all wrapped up and behind us, right? Is that your read of the situation? Right. What does it imply about what stress could potentially still exist?
I think that's an excellent way to read it. I think it's a reminder that the stresses on the banking system aren't all just bad management at one firm. It is the inverted yield curve. It is sort of a generational shock in interest rates that banks are having to grapple with, and as we just discussed, may not turn around anytime soon. And that's a reality that makes it hard for banks to make money, harder. And also they've faced more deposit flight and deposit sensitivity than they're used to. So this is a tough operating environment, particularly for mid-sized and smaller banks. It still is. That hasn't changed. And that is one reason that Chair Powell described the go slower strategy, was that this kind of credit constriction that we're very much in the middle of is not something that materializes from one day to the next. It takes some time. Economic models suggest this is a process that can take 12 to 18 months. So this credit headwind and these banking sort of stresses could be with us for some time. The Fed is going to have in hand at this meeting, by the way, the Q3 reading of the Senior Loan Officer Survey, which shows us how many banks are tightening credit standards and what's happening to loan demand. So the Fed will have that. We don't get that till Monday. But one thing that I looked forward to hearing at the press conference is, what are they seeing in that data, and what does that make them think as far as how much credit constraint is going to do their job for them?
And just quickly, also on the docket, there is a hearing on Thursday at which regulators are going to consider some new capital requirements for banks and for a broader swath of banks, right? Does this sort of give them more ammunition? And do you think that that helps or hurts on balance from a credit perspective?
Well, it helps from a structural standpoint. One of the reasons that Silicon Valley Bank ran into trouble was because they grew very, very fast when those higher requirements were released in 2017 or were eased in 2017. So that will help restore some structural discipline in the banking system. But that also means, from a cyclical perspective, that credit is likely to be a bit of a headwind for the economy. So the Fed probably doesn't need to do as much with interest rates, because credit availability, the lending standards are going to be tightening for going forward over a decent period of time.
Yeah, really interesting stuff. Julia, thank you as always for your perspective. Julia Coronado, Macro Policy Perspectives founder and president. Appreciate it.
My pleasure.
Let's do a quick check of the market, sponsored by Tasty Trade. Almost an hour into the session, and we now have a mixed picture. But overall, we're not seeing much change in the indices, right? The Dow is just up 2.5 points, not even now. The S&P is down just about 0.1%, as is the Nasdaq. As we know, during earnings season, it has a lot more to do, especially on a day like this when there are so many large companies reporting, with those big individual movers. When you have an Alphabet going up, a Microsoft going down, when you have Boeing and AT&T that we're watching as well, all of that kind of cancels each other out on the index level. We've got much more markets action coming up. Stay tuned. You're watching Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Brian Sazi, live from the Nasdaq right now with a very special guest, Atlanta Braves CEO Derek Schiller. Derek, good to see you here. Not often you get to think about investing in a sports team, especially a sports team with the background of your franchise. Why was now the right time to take this public?
Well, first off, I'll say we love being in New York. We tend to have a lot of success in New York.
Just not Flushing, Queens, right? Okay, go ahead.
So why not come on over here and see what kind of success we could have with you? I mean, we're very proud to now convert what was a tracking stock into a full asset-backed equity and officially trade on Nasdaq. It's given all of us a great deal of pride. We obviously celebrated that this morning, and we're off to the races. And we're excited to tell the story of who we are and what makes the Atlanta Braves so great.
Tell us that story, because I think a lot of folks on the Yahoo Finance platform have never been able to invest in a sports team. Are you going to report quarterly earnings? I imagine you are. Are you going to hold earnings calls? And how is you as a CEO, how are you going to lead?
Well, first of all, as a public company, we have a certain amount of responsibilities. Disclosures and things like that. So we've hired a lot more lawyers and accountants.
Sounds about right.
This whole deal. But we will be issuing, the 10Qs, the 10Ks. We came out with, if you saw it, if anybody followed it, our initial issuance of the S4 had about 650 pages. All the different things you could learn about the Atlanta Braves, as well as some of our inner windings that we had with some of the other Liberty companies. So that was partly unwinded, which allowed us to break free from that. And that gives us the opportunity to stand on our own and, again, be listed here and traded here, independent from all of that. For us, the way we operate our business, we'd like to think that we're going to be able to do that largely the same each and every day. And for us, that's very successful. We've had a great deal of success in a lot of different ways. Fans might recognize the success on the field for sure.
How is that going to be like? Fans could invest in your business. How do you deal with fans potentially coming to your annual meeting and giving you some guff? How are you going to handle that?
Well, look, I'd say
it's like their wildest dreams.
I think I looked at this stock, what it was trading at, a single stock here today, and for about the price of a stock, you can buy a Braves ticket. So maybe now the next thing is you buy a Braves ticket and you buy your Braves stock at the same time, and you come in, you watch the game, and you realize, hey, I partly own this team.
No, that definitely makes a lot of sense, Derek. But last check, I saw the Atlanta Braves valued at about $2.5 billion. Mm-hmm. To me, from the outside looking in, that seems very low, especially when the highest, most valued franchise, at least according to Forbes, is the Yankees at $7.1 billion. Why do you think that is the valuation? And look at what other sports teams have been selling for, especially in private markets.
Well, for other sectors, other industries, this is going to sound crazy, but in professional sports, specifically North American professional sports in particular, the valuations are done on a multiples of revenue. And so if you use that and you look at the past number of teams that have traded, it's a calculation on the multiples of revenue. And they range anywhere from, the 3, 4, 5, all the way up to, I think the most recent Major League Baseball transaction was north of 6.5. So you sort of can apply that concept towards our total revenues and get a very loose, rough estimate as to what's going on. Now, that doesn't tell the whole story in our case, as you wouldn't think it would, because we also have done some things as part of our project in Atlanta, including investing in and building real estate. So we're up to greater than 2 million square feet of mixed-use development that's sitting on our campus. We're also looking at other opportunities in and around our campus. And so, there are some things that are going on there that are really interesting and probably don't quite get wrapped up into even the valuation that people are looking at right now.
Is that your growth plan? Because I look at other CEOs that we talk to here at Yahoo Finance, and they can open up a new store, develop a new hot dog, hire more employees, and come up with artificial intelligence. How do you grow? It's not like you're creating another Atlanta Braves franchise.
Yeah, look, the overwhelming amount of revenue and growth that can occur on our franchise is going to sit inside of the Atlanta Braves. But we should not in any way diminish what the value and the growth opportunities are for the Battery Atlanta, our real estate opportunities. And we're honing in on that. Mike Plant and his group really working hard every day trying to figure out what those opportunities are and seeing whether or not we can put them together. As an example, right now, if you were to go down to Atlanta, right behind our home plate, just across the street, we're building a new building for Truist Securities. That's another couple 100,000 square foot building. There'll be an active trading floor that sits on that building. We have about 1,000 very well paid employees that are in that building. So not only do we get the building and all of that represents the value of that, but all those people spill out, come into the Battery, eat in the restaurants, shop, do all the things that try to create even further value. So all of these things are really working together, and we see that there's still more opportunity for growth.
Right now, your team is in first place. Just absolute on fire, having a bang-up year already. I'm sure getting visions of getting to the World Series. But what if you weren't in first place? Now that you're a public company, do investors, you anticipate them pressuring you to cut payroll, make drastic changes?
Yeah, the way we've looked at this, and we've had some time to think about this concept, this discussion and question is, should we in any way, shape, or form reflect off of what the value of the stock price is? Trades up one day, trades down one day, dramatic or not. Is it going to impact the way in which we operate our business? And the simple answer is absolutely not. We can't go on doing things that way. You know what? There's a lot of other things that drive values in these companies, as you know, far better than me. And so we're going to stay away from that. We're going to continue to operate our business the best way we know how. We've got a terrific team of people that are doing that exceptionally well. As you mentioned, team on the field playing really well. This year we've got 8 All-Stars, a new franchise record. Got a great team playing together, having a lot of fun. Who knows what might happen, but obviously we think that we've got a team that can ultimately win the World Series.
I think this next question is important to your story as investors think about investing in a franchise like yours. $208 million payroll, 8th highest in Major League Baseball. The Mets, awful season right here in New York City. Over $300 million payroll. Why are you able to find success and a team like that just can't get it done?
Well, it's difficult to comment on the other teams, but I'll tell you that for a number of years, and maybe this year is yet another case example, by spending the most amount of money on your player payroll, it's not an automatic foregone conclusion that is going to generate a better team. There's so much that goes into how a team gets assembled. We were talking off air about the role of chemistry and trying to reduce drama and how everybody kind of comes together, that cohesive nature. One of the things that Alex Anthopoulos, our general manager, person who selects our team, one of the things he does exceptionally well is really understands the makeup of a person and how they're going to come into our clubhouse and what impact that is going to have. In effect, a psychological review of all of this. And he's really aware of those things, and even just trades that we're doing right now. I mean, these are things we say, okay, is this going to help us? Is it going to hurt us? What's it going to do to the dynamic? What's it going to do to the drama or lack thereof that's in this clubhouse?
Derek, real quick before I let you go, is that a World Series ring? I've never seen anything like that before in my life. Well, I've been doing this for 20 years. I've never seen that before.
I know a lot of people up here in New York don't have these.
So I definitely don't have one.
So I
saw what you did there.
So I thought I might bring these out. We wear them out on special occasions. It's something really fun.
I'm afraid to touch it. This thing is wow.
Wow. Obviously
that's heavy. Just get it out of my hands.
We won that in the 21 World Series. The players, the team came together, gave their thoughts on what to do with it. It actually opens up.
That's wild.
And you can see a miniature version of Truist Park inside of there, and all kinds of other little things. So it's a special representation of winning the World Series back in 2021. I hope that I have many more of these on other fingers.
Quite confident to say that the team in Flushing, Queens will not be winning one this year. Atlanta Braves CEO Derek Schiller, good to see you. Congrats on the IPO. Very, very cool to see. Appreciate it.
Thank you very much.
All right. And, well, now we're off to break.
Have you seen the Barbie movie? We're talking a lot about it.
We have not, but we have made reservations or booked tickets to see Oppenheimer on Friday. Been checking every single day. That's the one we really are excited to see.
You're an Oppenheimer person. One of the rare few that we've spoken to thus far. Yes. Although there are a lot of people.
I wonder what that says about me, actually.
It says you're intellectual.
Oh.
There you go.
When digging into investment opportunities to build out your retirement portfolio, stocks seem to be the most obvious option, but our next guest says that there are several other opportunities that should be considered. Lawrence Sprung, who is the Midland Financial founder and author of Financial Planning Made Personal, joins us now. Great to have you here in studio with us.
Thank you for having me.
Absolutely. Okay, so a lot of people largely kind of think about stocks and think about kind of the long time horizon that they may have, but you're saying look somewhere else. Where's the top place that you're advising people to look other than stocks?
So first and foremost, if you're investing long term, you should be looking at your retirement plan and making sure you're capturing at least your employer match. If you're getting a match from your employer, it's free money. Make sure you're contributing at least that much. And I agree with you, when you hear about investments, people's mindset go immediately to stocks. And it doesn't have to just be stocks. You want to build out a balanced portfolio.
And so to Brad's point, kind of what's the most attractive alternative?
So the whole idea is, and as I talk about in my book, Financial Planning Made Personal, it's really up to each individual to build out an asset allocation that is perfect or right for them. That's going to include stocks, that's going to include bonds, and within stocks, that may include several different types of stocks: large cap, mid cap, small cap. Bonds may include government bonds, international. You also want to look at commodities. That might be a good place for an inflation hedge, right? Or real estate are a good option. So it's not just about focusing on stock, it's building out a diversified portfolio within that retirement plan.
One of the things that we think about too is the different streams of income that one can set up in order to have their money perhaps generating even more income while they are retired. And so how can one adequately set themselves up for that as they are heading to or getting towards retirement?
So the most important thing is to have a plan well in advance of retirement and understand where these income streams are going to come from. Some of that may come from a pension, some of that may come from a retirement plan. Maybe you went out and bought some real estate. Maybe that's in your DNA to own and operate a piece of real estate that in retirement will be paid off and produce an income stream for you. Maybe it's a business. Maybe you have a small business that's not dependent upon you as an owner. Maybe you can manage it, have other people operate it, and receive an income stream from there too. It's a matter of what your risk appetite is, how much income you need to derive in retirement, and look at where that's coming from.
I'm also curious, when you talk about things like real estate or a business, it's sort of daunting in people's minds, right? To take on a home mortgage. Are there options that you recommend to people where they can buy a piece of something, for example?
Yeah, sure. That's a great point. You know, when it comes to real estate, there's many ways to enter it, and I was just giving you one example. If you're not somebody who wants to be that owner-operator, you could look at real estate investment trusts where you're going to own a piece of a portfolio and perhaps get an income stream. If you're even more savvy, there might be private opportunities where you could join other private investors, own a pool of assets, and get an income stream in retirement. There's really a flavor for everyone. It's just a matter of finding what's right for you in terms of what your goals are, your risk profile, and what your time horizon is.
I, like many millennials and Gen Zers out there, are monitoring immensely close the future financial status of the Social Security program as well here. And by some of the projections, I mean, we're looking at like 2035 as where they're looking for to not be able to pay out the entirety of some of the benefits that were expected by many people in the workforce. So where should you be backfilling for the absence, or what generations should not expect to be able to lean on Social Security?
So there's a lot to unpack there, but I don't know if this will make you feel better or worse, but this has been a conversation since I started in this profession 20 plus years ago. I've been hearing about Social Security running out, et cetera. And there have been several iterations, changes that they've made to Social Security in terms of raising the income limit as far as you're paying in. The reality is the vast majority of folks who are retiring are really relying heavily on Social Security. So it's important to the fabric of the country to maintain that status of Social Security. So I don't think they're going to, get rid of it, but they are going to tweak it. So it's going to be very important for people in your stage, millennials, et cetera, to make sure that they're positioning themselves in a way to have other income streams. And it's a matter of finding what's right, setting up a dividend-paying stock portfolio, whether it be real estate, having a side gig, whatever that may be, it's something that they should start considering and, more importantly, planning for.
So As they consider that, I'm just curious finally about other alternatives, right? Whether it be crypto or wine, which people can invest in, or antique cars or gold coins or whatever, what have you. And I know you said everybody's different, but I think of that as sort of the other basket. How should people be thinking about that basket?
So that basket is very wide-ranging, and I think there's a difference between, for instance, investing, quote unquote, in crypto or investing in a wine collection, right? I don't think the average person has the ability necessarily to invest in a wine collection unless they're doing it in some kind of private placement and group platform. Crypto obviously is a little more accessible, and I think there's different risks involved, right? Crypto is something that they can, in most cases, easily convert to cash, assuming that crypto is still around and viable. Wine, that may be a little lower ability to convert that into cash or an income stream when that time comes. So I think you have to look at the liquidity factor of these various investments and what fits and what you think is going to be around and viable long term as well.
All right. Lawrence Sprung, who is the Midland Financial founder and author of Financial Planning Made Personal. Thanks so much for joining us here on set.
Thanks for having me.
Absolutely. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
It's a very busy week. We got the Fed. We have a lot of big tech earnings, a lot of earnings period. Will it provide the clarity that we need for the market?
I think in terms of the macro data, it's still going to confirm the soft landing narrative. I don't think any of the data we get this week will really change that. I also don't think the Fed's going to rock the boat too much. We'll have to wait either to Jackson Hole or the September meeting to get any kind of clarity on the rate path ahead. Which brings us to the most important thing of the week, which is the micro earnings. And specifically tech earnings and question marks around both the top line as well as the margin outlook for tech. Given how powerful the rally has been this year, it's really crucial for those earnings to beat expectations.
A crisis seems to be unfolding in the commercial real estate market. It's been much discussed, all thanks to lower demand for office space and higher interest rates. According to the National Association of Realtors, the U.S. office vacancy rate rose to 13.1% at the end of last quarter. That was an all-time high, despite more workers returning to work. Landlords are certainly feeling the pressure here, as are perhaps companies that build some of these buildings, unless they don't build offices, that is. That's where we bring in Bob Clark, founder and executive chairman at Clayco, which is one of the biggest construction firms in the country. We were just talking during the break. You don't do as much office space as you used to. How do you think people are assessing the office space crisis? Are they doing it correctly? Are they underestimating, overestimating? Give us your read.
I think it's worse than people think it is, really. I think it's in inner city areas, urban cores like Chicago as an example. There's about 165 million square feet of office space in the Loop in Chicago, and I think that vacancy rate is as high as 50%. It's quoted by JLL as about 35%, so the national average might be 13 or 14, but in the cities, in the cores, in Los Angeles, Chicago, San Francisco, it's much higher and it's much worse. Of an overall impact on people in those communities and the economy, I think.
How have companies then at the same time been kind of revamping their leasing structure, trying to figure out how they can restructure the costs that they are paying in this interim period?
Yeah, I think there's a waterfall impact that also, it affects brokers, it affects banks, it affects the landlords and developers. It also impacts all the people that work in all of the support services and has a kind of disproportionate negative impact on minorities in the community and that sort of thing. So I think it's a really big negative impact overall, and I think it's going to take. I do think it'll correct itself over time. I think business people, leaders of businesses, want to bring their people back to work. We brought our people back immediately because we had so many construction people in the field that we didn't feel comfortable kind of working from home while our people were forced to work in the field. The banks, the big finance houses, the big real estate brokers, the architects and engineers are just now starting to really bring their people back to work, which I think is way too slow. But I do think that over a long period of time, the office sector will kind of self-correct and correct itself, and some of these buildings will find adaptive reuses and that sort of thing. But I think it's like a 5-year cycle, because I think it's going to take quite a bit of attrition, quite frankly, with the large employers to revamp their workforce to have people back in the office instead of in the grocery store.
And now, you said that you have dramatically decreased your exposure to office. Was that by design? Was that just a product of demand decreasing? How did that happen?
I'd love to say we're geniuses about that, but the truth is we started driving our capacity towards industrial as the market went from 200 million square feet a year during COVID to 400 million square feet a year. We continued to build 10% of all that product built. So that was really taking capacity away from our traditional office sector business. And at the same time, we really saw an opportunity in the advanced manufacturing sector. The chip manufacturing plants all started talking about building a couple years ago, 3 years ago. Today, all of those projects have come to fruition. The chips, the advanced manufacturing, the solar plants, the whole so-called Bidenomic-driven projects are really, really taking shape, and we're participating in that in a big way.
When you think about adaptive reuse, one huge shift that we have seen, or at least quest for more space, is in the data center side of real estate. Where have you been seeing even more of the cloud-centric companies or the data center-driven businesses looking at some of this real estate and saying, okay, if we don't have to build out something from the ground up, this might be advantageous for us?
It is an opportunity as long as they can get the power. And today, that's where the cloud is searching, right? Is where is there enough electricity? These projects are 40 megawatts up to 200 megawatts. That's a lot of electricity. And so you have to find places where there's a big substation and where the utilities exist. because all of the power companies, the Dominions and the Georgia Powers, are getting close to capacity. They can't add the capacity as quickly as the cloud is expanding right now, but this is going to be a big story in the economy. I think over the next 4 or 5 years, the booming cloud companies like Blackstone making tremendous moves into the cloud, and because that's where there's going to be a lot of demand, especially with artificial intelligence.
It's so interesting to me because on the one hand, you have Office, which is dead, and then you have all this other stuff that is going gangbusters from what it sounds like.
It's a tale of two economies, right? So in the piece I wrote for my team, you've got office and multifamily, you've got pressure from interest rates, which I don't think are all that out of control high. Honestly, if you really think 5-6%, that's a kind of a make sense interest rate. People make a lot of that, but I thought 2% interest rates were too low. I think that multifamily, office, and all those sectors are going to go through this really negative cycle, but I think the big story for the economy will be almost $1 trillion worth of projects in advanced manufacturing, chips, the cloud, and it's an overwhelming, and I think not completely well-known part of what's going to be happening in the economy for the next decade, but I think it's a decade runway for the top 100 builders in the country.
So that's good news for you. You mentioned interest rates, and of course the Federal Reserve is set to meet this afternoon, expected to raise rates again. This might be the end, but still, on a long timeline, maybe they're not that high. It is the highest in 22 years.
Yeah.
Have you seen any slowdown in financing for your projects as well,
Sure.
even in the areas that are healthier?
Yeah, I'm not sure that because of the interest rates, I just think lenders right now are trying to pile cash up, which they should be doing. And I think that lenders are not lending right now. They're just taking a more conservative approach. They want to see the fallout from the office and see what's happening. So I don't think it's interest rates when we model our developments right now. Obviously, the projects we modeled at 2.5% are getting hurt, but that's a short-term problem. If we're modeling projects now at the current interest rates, we're going to be able to do business. Not everybody will be able to, but we've got an integrated model, so we can sharpen our pencil on construction cost and make some of that up. As long as it doesn't get too high, and I think it looks like to me what the Fed is doing is working, and hopefully we're going to get the projected kind of soft landing now. But I think that whether the interest rates go up a little bit more is not going to be too impactful, Bob, as long as they start coming down a little bit in the next year or so.
Yeah. Bob, really great perspective, and thanks so much for joining us in studio today.
Hey, great. Thanks for having me.
Absolutely. Bob Clark, who is the founder and executive chairman over at Clayco. Everyone, stick around. We've got all your markets action straight ahead. You're watching Yahoo Finance.
Inflation has been good for profits. Will disinflation be bad or be good for profits?
So far, we seem to be in a sweet spot where input prices are coming down at the same time that companies are still able to raise prices for their end consumer. Let's see how long that lasts. The question is, are margin expectations realistic for the second half of the year? They're quite high, so it's quite crucial for the earnings outlook in the second half and into 2024. Pricing power is going to be important, meaning it depends on the company.
Federal Reserve is meeting today to discuss what next steps it's going to take to hopefully stabilize the economy without causing a recession. It's widely expected to hike rates to a 22-year high, but the focus will be on any hints to where we go from here. U.S. inflation has seen a decline for 12 straight months. Now, while it's at the lowest level for over 2 years, it's still far from the Fed's 2% goal.
Yeah, in June, the FOMC had penciled in a final hike later this year. Strong consumer confidence data yesterday has raised hopes the central bank can tighten policy even further, perhaps without sending the economy into a tailspin. We'll be keeping an eye on that decision and any hints about what happens after this decision. That's from 2 p.m. Eastern, followed, of course, by a news conference with the Fed Chair Jay Powell at 2:30 p.m. So keep it right here on Yahoo Finance for all of that. In the meantime, Jared Blickery's got you for the next hour of trading.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery. Here's what I'm watching today. Focus on the Fed today as it concludes its two-day meeting, where we finally see the FOMC's 11th hike in this rate-raising cycle, plus the shocking number of people who are not thinking of throwing in the towel after retirement. We've got all the details. And home builders engaging in a bit of strategery. How they're luring first-time buyers from the sidelines. We've got the story ahead. But first, let's take a quick look at the markets here. You can see a mixed day, although the Dow barely in the green, might slip into the red here. S&P 500 down about 13 points, and the Nasdaq is the biggest loser of the day, down about 2/3%. Also want to get a check of the Treasury market. Seeing those quotes roll in, we have the 10-year T-note yield. That is down 3 basis points to 3.88%. The 5-year, the highest of the bunch, that is 4.14%, down 5 basis points from yesterday. Focus falls on the Federal Reserve today as they are expected to raise rates by 25 basis points, bringing the target rate to the highest point in 22 years. This is expected to be the last hike of the cycle, but has the FOMC accomplished its mission? Joining us now is John McLean, Brandywine Global Portfolio Manager. Thank you for joining us here, John. Your thoughts on what we can expect today, because I noticed the first line in your notes is mission not accomplished.
Yeah, absolutely. I mean, all eyes are on the Fed today, and we will see that 11th hike. I think we're going to see the 12th as well. And so we're going to be really paying attention to any incremental data that Jay Powell is going to give us. But, you know, we think that, look, remember what the Fed was talking about nonstop 6 months ago, financial conditions. They're fine. If you look at how the S&P or the Nasdaq is trading right now, we're basically only down a few percent from the beginning of 2022. Access to capital is readily available for reasonable credits. We're seeing wage growth continue and the consumer's still spending. So we think that these data points are going to be what the Fed is paying attention to and is going to lead to an additional 12th rate hike sometime at between the end of 3Q and beginning of 4Q.
And the market doesn't seem to be necessarily pricing in the risk that these rates are held this high for that long, however that long that may be, the risk being that we could slip into recession, credit is tightening across the board. Just tell us some of the risks here to the consumer and how they might protect themselves.
Well, yeah, I mean, look, the longer the Fed maintains a restrictive stance, and we think this is going to be for a reasonable period of time, probably 12 to 18 months before we start to see any type of rate cuts, the consumer is going to face some pressure. I mean, certainly there's been a lot of discussion around student loan repayments ticking back up, but if you look at your energy bills, they're ticking back up. Individuals are going to be, releasing cars that they got in 2020 or 2021 at 0% interest rates. Now that's going to be 6%, 7%, 8%, and the cost of a car is going to double for a number of people. So we think that, look, the U.S. consumer is going to spend until it's broke. And so we would really encourage individuals to understand that today's market is not what the economy is going to look like over the next 12 months and to encourage some additional savings.
One of your comments on the banks is when banks don't compete, consumers lose. They're in a race here, and we just saw, at least price-wise in the stock market, we saw a big drop-off yesterday towards the end of the day on news that the Bank of California was going to enter into an agreement with another small regional bank, PacWest, but they're bouncing today. What should consumers, what should stockholders make of this recent move and all these moves in the banking sector?
Well, sure. Banks are focused on lowering loan to deposit ratios, which means they're not making loans to consumers right now. They're focused on building capital ratios and shedding their risk-weighted assets. You know, this deal between Bank of California and PacWest is certainly what we expect to see in the marketplace, which is where a lot of small, medium-sized banks are going to merge because they are very aware that they're going to be under additional regulatory scrutiny over the next year or 2 years. So the M&A consolidation is very positive, actually, for the banking space. It's much better than the government coming in and shutting down banks. So we would expect to see a number of small to medium-sized banks get together over the next 3 to 6 months.
Well, agree there. The FDIC can be a bit unpredictable. Given everything we've talked about so far, how would you express this in stock portfolio holdings, things you're excited about, things to stay away from this year?
No, certainly. I'm not very interested in the stock market at this point in time. I think we've seen a nice run up here. I think if you look at where the stock market's trading in terms of forward PE ratios, it's not particularly compelling. Certainly there's been a lot of discussion around, the largest names driving returns here, and they all have reasonably strong outlooks. But the stock market's really ignoring the fact that the cost of capital for companies has gone up 500 basis points over the last 15 months. And so interest expense is going to grow. The availability for cheap capital is relatively gone here. And so we're going to see corporations reduce leverage. We're going to see less return of capital to shareholders. And so what we would say is you want to take a bit of a barbelled approach here because you're paid to be patient in fixed income. You're supposed to take the attractive carry that you're getting either in something like short duration high yield or 5 to 10 year treasuries. And you barbell that with, parts of the marketplace that have nonlinear upside, have this exponential type of upside. And so I think traditional equity right now is overvalued, and there are much better opportunities to generate strong risk-adjusted returns in fixed income.
Especially on the risk-free side, which is just incredible given where we are. I really appreciate your insights there. John McClain, Brandywine Global Portfolio Manager. The Fed expected to make its final hike of the tightening cycle at today's FOMC meeting. So what is a potential path ahead for Federal Reserve policy? Joining us now is Yahoo Finance reporter Jenna Schonenberger. Jen, you're going to be there later representing us at the press conference. What are you expecting? What are investors expecting from today?
Hi, Jared. I will indeed. While investors are expecting another 25 basis point hike later this afternoon, don't rule out the potential for another hike later this year. Officials have penciled in 2 more rate hikes for the second half this year based on higher expectations for core inflation. But as you suggest, Wall Street is betting that today will mark the peak on rates. Investors pricing in a nearly 80% chance the Fed will hold rates after this meeting in September, and a 57% chance they'll still hold in November. For the Fed to stop raising rates after today, the central bank would likely need to see more readings on inflation that show cooling, like the Consumer Price Index for June. And Wall Street is betting just that. Capital economics economist Andrew Hunter says a run of softer inflation readings over the next few months will convince the FOMC to scrap plans for further tightening. Goldman Sachs is another one in the camp who thinks today's expected rate hike will end up being the Fed's last. Goldman's chief economist Jan Hatzius saying, quote, core CPI inflation slowed sharply in June in what we think will prove to be a turning point in the inflation story. By the November meeting, we expect that the core inflation trend will have taken a decisive step down and that this will convince the FOMC that a second hike is unnecessary. While Fed Chair Powell has said rate hikes at consecutive meetings aren't off the table, investors this afternoon are looking for whether Fed Chair Powell will emphasize an every other meeting approach to hiking rates. Investors will also look to Powell to offer more clarity on what the committee would need to see to be more comfortable moving into an extended hold. And ahead of this blackout period, we sort of got a hint along those lines from Fed Governor Chris Waller saying that if we see 2 more prints on inflation similar to the last one that we saw on CPI, then the data may indicate that we can stop. Jared?
Yes, thank you for that, Jen. And we're going to be watching live here at 2 p.m. today, so everybody stay tuned for that. And a big pop from Union Pacific stock today, jumping the most since the dog days of the pandemic in 2020, up to price levels not seen since August of 2022. Earnings at the railroad company were not stellar. More on those in a minute. But shareholders seem to like the switch up in the C-suite, inviting back Jim Vena to replace Lance Fritz as CCO, who's stepping down. Vena is a member of the FedEx board and spent most of his career at Canadian Railway, though within the last few years he served as both senior advisor to the UPN chair and as a company's COO. Back to second quarter results. Operating revenue was a miss, shrinking 5% year over year. Outgoing CEO Lance Fritz said this in the report. The results this quarter were impacted by softening consumer markets, inflation, a one-time labor expense, and increased workforce levels. I'm also watching shares of Texas Instruments. The stock there down almost 6% after reporting results for its June quarter. The company beat analysts' expectations for a revenue and profit look, but a cloudy outlook is weighing on the investors. The semiconductor company forecasting revenue in its next quarter of $4.36 billion to $4.74 billion. That is below street expectations. They're citing weakness in its market driven by sluggishness in consumer and enterprise demand. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
It's a very busy week. We got the Fed. We have a lot of big tech earnings, a lot of earnings period. Will it provide the clarity that we need for the market?
I think in terms of the macro data, it's still going to confirm the soft landing narrative. I don't think any of the data we get this week will really change that. I also don't think the Fed's going to rock the boat too much. We'll have to wait either to Jackson Hole or the September meeting to get any kind of clarity on the rate path ahead, which brings us to the most important thing of the week, which is the micro earnings. And specifically tech earnings and question marks around both the top line as well as the margin outlook for tech. Given how powerful the rally has been this year, it's really crucial for those earnings to beat expectations.
Let's do a check of the market sponsored by Tasty Trade. The Dow, the only one in the green and just barely by 15 points. S&P 500 now down 0.25%, and the Nasdaq down about 0.5%. While the word retire may mean calling it quits for some, others are not ready to throw in the towel just yet. A new survey from Transamerica Center for Retirement Studies showed that 55% of people plan to continue working after they retire, including me, by the way. Yahoo Finance's Carrie Hannon joins me with all the details. Carrie, any surprises here?
Well, Jared, I absolutely love this. I'm a big fan of working in retirement, right? Mm-hmm. There's really good reasons for this. There's so many benefits. First of all, even people who have saved appropriately for retirement are considering adding, just doing some kind of additional work, whether we're not taking pedal to the metal.
Sure.
This is part-time or flex time. And so what we're talking about is what they can do is it gives them a financial safety net in a sense, right? So it not only, yes, you can dip off, stave off dipping into your retirement accounts. Yeah. You might be able to push back delaying your Social Security benefit. And if you delay between your working retirement age and 70, it bumps it up 8% annually.
It should make a big difference.
It's huge. I mean, that can really up. Not a lot of investments are going to give that to you. And it also, you might even be able to continue to add to your retirement accounts. Those are the financial reasons. The health reasons are psychologically, it is just good to keep working. Studies have shown that cognitive decline after people retire is quite significant. And so if you can use it or lose it, basically. So sure. I love this idea of keeping engaged, you're networking, you're feeling relevant. Those are really great benefits for it. Now, let's stop for a second and say there are some roadblocks. Mm-hmm. Here's what's happening. People are saying, hey, I want to continue working in retirement. It's going to shore up my retirement accounts because I haven't saved enough. But in fact, many of them step out of the workplace and are unable to do that because of health reasons or because caregiving for an aging relative. These are two big issues. Now, remote work is doing a lot to help this, right? If you can find opportunities to work remotely, this has taken off after the pandemic, the opportunities are going to be there. The other roadblocks that we're finding are people are not actually preparing themselves for this. They say, I'm going to keep working, but they're not adding skills. They're not upskilling. They're not adding anything to value themselves. They're not staying abreast with their industries. They're not networking. And they say they're not even paying attention to their health, for gosh sake. So this is really important.
Kind of a paradox.
So that's a problem.
Yeah. Well, let me ask you then, how are employers responding to this? Are they incentivizing this in any way? Or because you would need some cooperation, I would think, at the employer level.
It's huge. And I appreciate you asking that because what's happening is some companies are catching on, but there's still a lot of companies that do not offer phased retirement. They don't have flexible schedules, part-time opportunities. And so this is, there's something that they need a little bit of a wake-up call, and this is why. Demographically, they are going to have to. By 2034, there are going to be more people over 65 in America than under 18. There is simply not enough younger workers moving up through the chain in order to supply the work chain. So they're going to need to find ways to retain and recruit older workers. This is simply a fact. So the headwinds are starting to subside.
Yeah, I'd say the demographic changes underfoot right now are just phenomenally huge. So thank you for joining us, Carrie Hannon, as always. Though the market seems to be resilient, some aren't quite as convinced about the economy. So where should you be positioning your money? Our next guest has a few suggestions. Dave Nadig, Vetify financial futurist, joins us now for the ETF report brought to you by Invesco QQQ. Dave, always great to see you here. Just off the top, so what do you suggest given the current market environment that tends to be vexing a lot of investors right now?
Well, we've had a lot of folks talk about barbelling. You had a guest on just recently talking about trying to stay safe with the risk-free rate with treasuries, but then sort of look out into those corners of the market where you might be able to get some outsized returns, find real value that's not overvalued. For that latter thing, what we're hearing a lot from advisors about is cash flow investing. That is looking at the cash flows of companies and looking at those companies that have an excess of free cash flow, whether or not that's turning into dividends or not. This is a metric that's been used as a proxy for value, if you will, for quite some time. And frankly, it's really worked for investors over the last 2, 3, 5 years. The big player in the space is COWS from Pacer. That's the ticker COWZ for cash cow, if you like that. It's about a $12 billion fund. It owns 100 securities out of the Russell 1000 top 1,000 securities in the US, focused on those with the highest free cash flow. Over the last 3 years, it's up 90% versus the S&P being up about 50%. And over the last 2, 3, 5 years, it's beaten both the S&P and traditional value plays. So it's been a really interesting way to be in the market, but not be in there with 23 PE and no dividends coming out the other side.
Yeah, one of the themes I've heard over the last 2 years, which seems to have worked in a lot of different markets, is quality of the balance sheet, and I think that kind of speaks to it. Okay, we were talking about stocks there. What about bonds? Anything interesting happening in bonds that you like? Any opportunities?
Yeah, so the flip side of that barbell, if you will, of trying to be a little bit safe with your equity is trying to manage your duration correctly, particularly on a day like today where, most of us think we're heading into another rate hike. You don't want to be long the 20 on a day that a rate hike's coming in. Everybody understands that about duration. When we poll advisors, we find that 50% of them are holding a duration shorter than the average benchmark, the Bloomberg aggregate, and about only 17% are holding longer than that duration. So how do you tweak that if you've got an active bond manager that you really like and you're just trying to get shorter on duration? One thing that we've seen is a rise of these very targeted treasury products. I'll highlight the ones from bond blocks, where you can get individual tickers that get you duration of 6 months, 1 year, all the way out to the 20-year. And so if you're looking to bring yourself in a little bit there, you can just go ahead and grab a little bit of extra exposure in something like XHLF, which is their 6-month duration treasury fund. And just adding a little bit of that can help you bring that duration down, lower your exposure to a day like today when we're going to get a rate hike.
All right, you're an investor, you're watching Yahoo Finance at 2 p.m., you get the big decision, then you sit through all of Powell's testimony later today. Is it going to mean anything in terms of the overall strategies we're talking about right now, or is this just kind of a perfunctory checkmark box to get on to the next meeting, perhaps?
I think it's mostly a perfunctory checkmark. I suppose there could be something in the speech and the commentary that really is a surprise, but frankly, I mean, nobody ever really expects surprises, but I think this is pretty well understood. We are rolling off the top of the hike cycle, whether it's now, whether it's the next one. I don't think anybody thinks we're headed towards 8%, right? I mean, we are definitely towards the end of the cycle. It's just a balancing act between the economy, inflation, and rates, and whether or not we can just get that Goldilocks soft landing. I'm a little bit skeptical, but I think there's probably a higher likelihood than not.
Let me ask you, we're talking about in broad strokes here, the equity and bond markets. Anything else catching your eye recently? I just noted WTI crude, for instance, jumped above its 200-day moving average. Commodities have been perking up. Anything in that arena?
Well, interestingly, you're right. The performance of some commodities and real assets have perked up, but there have been no flows whatsoever. Advisors and investors have really just been eschewing the entire space after really running into commodities last year when nothing else was working for folks. So it hasn't been a big push back. However, I would point out a lot of folks are looking at energy as a potential winner here over the next year or two, whether that's raw energy in the form of something like WTI or looking at things like midstream, looking at pipeline companies, looking at those places where a strong economy is going to keep that oil moving.
And then we got time for one more here. On the international front, well, China slowed down, much talked about this year, really not rebounding as quickly. Anything in that arena or with any respect to anything you see around the world that's interesting?
Well, we've seen a lot of interest in Japan. And now, interestingly, this time around, while there has been money flowing into Japan and that money's been well rewarded, folks haven't been hedging out the currency risk there, which is probably a mistake. The big fund there is DXJ from Wisdom Tree, which is a currency hedged version of getting Japan exposure. I think that's a really interesting play. The other thing I hear from a lot of strategists is to keep your eye on Europe. So I think that looking at those hedged Europe exposures, again, another really interesting way to play it.
Yeah, really interesting to track these fund flows across the world. Thank you, Dave Nadig, VettaFi financial futurist. All your markets action is ahead. Stay tuned. You're watching Yahoo Finance.
Inflation has been good for profits. Will disinflation be bad or be good for profits?
So far, we seem to be in a sweet spot where input prices are coming down at the same time that companies are still able to raise prices for their end consumer. Let's see how long that lasts. The question is, are margin expectations realistic for the second half of the year? They're quite high, so it's quite crucial for the earnings outlook in the second half and into 2024. Pricing power is going to be important, meaning it depends on the company.
Let's take a look at shares of Atlanta Braves Holding, currently trading at $43.69, down about 1.4%. After the Braves became the only publicly traded franchise in Major League Baseball with a listing on the Nasdaq this morning. This following a split from Liberty Media. CEO Derek Schiller said the move would not cause disruption, but gives fans an opportunity to feel a new level of investment in the team. Earlier today, he sat down with Yahoo Finance's Brian Sazi at the Nasdaq. Let us take a listen.
Well, first off, I'll say we love being in New York. We tend to have a lot of success in New York.
Just not Flushing, Queens, right? Okay, go ahead.
So why not come on over here and see what kind of success we could have with you? I mean, we're very proud to now convert what was a tracking stock into a full asset-backed equity and officially trade on Nasdaq. It's given all of us a great deal of pride. We obviously celebrated that this morning, and we're off to the races. And we're excited to tell the story of who we are and what makes the Atlanta Braves so great.
Tell us that story, because I think a lot of folks on the Yahoo Finance platform have never been able to invest in a sports team. Are you going to report quarterly earnings? I imagine you are. Are you going to hold earnings calls? And how is you as a CEO, how are you going to lead?
Well, first of all, as a public company, we have a certain amount of responsibilities. Disclosures and things like that. So we've hired a lot more lawyers and accountants.
Sounds about right.
This whole deal. But we will be issuing, the 10Qs, the 10Ks. We came out with, if you saw it, if anybody followed it, our initial issuance of the S4 had about 650 pages. All the different things you could learn about the Atlanta Braves, as well as some of our inner windings that we had with some of the other Liberty companies. So that was partly unwinded, which allowed us to break free from that. And that gives us the opportunity to stand on our own and, again, be listed here and traded here, independent from all of that. For us, the way we operate our business, we'd like to think that we're going to be able to do that largely the same each and every day. And for us, that's very successful. We've had a great deal of success in a lot of different ways. Fans might recognize the success on the field for sure.
How is that going to be like? Fans could invest in your business. How do you deal with fans potentially coming to your annual meeting and giving you some guff? How are you going to handle that?
Well, look, I'd say
it's like their wildest dreams.
I think I looked at this stock, what it was trading at, a single stock here today, and for about the price of a stock, you can buy a Braves ticket. So maybe now the next thing is you buy a Braves ticket and you buy your Braves stock at the same time, and you come in, you watch the game, and you realize, hey, I partly own this team.
No, that definitely makes a lot of sense, Derek. But last check, I saw the Atlanta Braves valued at about $2.5 billion.
Mm-hmm.
To me, from the outside looking in, that seems very low, especially when the highest, most valued franchise, at least according to Forbes, is the Yankees at $7.1 billion. Why do you think that is the valuation? And look at what other sports teams have been selling for, especially in private markets.
Well, for other sectors, other industries, this is going to sound crazy, but in professional sports, specifically North American professional sports in particular, the valuations are done on a multiples of revenue. And so if you use that and you look at the past number of teams that have traded, it's a calculation on the multiples of revenue. And they range anywhere from, the 3, 4, 5, all the way up to, I think the most recent Major League Baseball transaction was north of 6.5. So you sort of can apply that concept towards our total revenues and get a very loose, rough estimate as to what's going on. Now, that doesn't tell the whole story in our case, as you wouldn't think it would, because we also have done some things as part of our project in Atlanta, including investing in and building real estate. So we're up to greater than 2 million square feet of mixed-use development that's sitting on our campus. We're also looking at other opportunities in and around our campus. And so, there are some things that are going on there that are really interesting and probably don't quite get wrapped up into even the valuation that people are looking at right now.
Is that your growth plan? Because I look at other CEOs that we talk to here at Yahoo Finance, and they can open up a new store, develop a new hot dog, hire more employees, and come up with artificial intelligence. How do you grow? It's not like you're creating another Atlanta Braves franchise.
Yeah. Look, the overwhelming amount of revenue and growth that can occur on our franchise is going to sit inside of the Atlanta Braves. but we should not in any way diminish what the value and the growth opportunities are for the Battery Atlanta, our real estate opportunities. And we're honing in on that. Mike Plant and his group really working hard every day trying to figure out what those opportunities are and seeing whether or not we can put them together. As an example, right now, if you were to go down to Atlanta, right behind our home plate, just across the street, we're building a new building for Truist Securities. That's another couple 100,000 square foot building. There'll be an active trading floor that sits on that building. We have about 1,000 very well paid employees that are in that building. So not only do we get the building and all of that represents the value of that, but all those people spill out, come into the Battery, eat in the restaurants, shop, do all the things that try to create even further value. So all of these things are really working together, and we see that there's still more opportunity for growth.
That was Yahoo Finance's Brian Sozzi with Atlanta Braves CEO Derek Schiller at the Nasdaq earlier. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
You just got married. Can you tell us what your favorite present was that you got?
Oh, I can tell you what my husband's favorite present was, which was an ice cream maker.
Oh, that's a good one.
So we've got gelato tasting on tap every week.
Wow, so you not only is it the favorite present, but you actually have used it a lot.
Well, once, but they're big
classic
plans.
Is that you get the amazing present and you're like, wow, this is great. And you use it, and then it sort of fades and uses.
We'll have to see. TBD.
Okay, we'll check back in on that one.
Home builders are downsizing the American dream to lure in entry-level buyers who are frustrated by resale housing market. Yahoo Finance's Danny Romero joins us with more. Danny, the details, please.
Jared, it's all about meeting affordability. So the size of a home correlates to interest rates, with mortgage rates hovering over 6%. The game here is the more that you can afford, the size of your home gets bigger. The less you can fork up, the size of your home gets smaller. What is the current size of a new single-family home right now? Data from the Census Bureau shows that the average square footage of a new home stood at 2,469 square feet. You can see that on your screen right now in the first quarter of this year. That's down 2% from the previous 6 quarters, which stood at 2,525 square feet. The difference is 56 square feet. That equals to a nice size bathroom, but a smaller home isn't killing buyer appetite. First-time home buyers are responding. Pulte Group said in their second quarter earnings call on Tuesday that first-time home buyers remained financially resilient, and they're also dipping into their personal savings to go towards their down payment. And millennials are also asking for support from their parents. But you know what's interesting here, Jared, is the fact that even though homes are shrinking in size, the size of your kitchen is actually going to get bigger or will continue to get bigger. That depends obviously on the buyer itself, but it also shows that people are probably enjoy being in the kitchen.
Sounds like that might be a development that came post-pandemic, or kind of created that vibe there. We did get some disappointing today on the new home sales front, breaking a 3-month upstreak. So prices actually lowering for these new units coming online here.
Jared, overall sales pace looks positive. Buyer demand is strong. The lack of the resale market will help boost the new homes market. And there's also a growing pipeline of new homes that are going to be going onto the market. So we also heard from CFO of Whirlpool, Jim Peters, talk about that this is really a bright spot. Take a listen.
I think then as you look to next year, we would expect to begin to see, as interest rates stabilize and it's kind of been absorbed and normalized within the marketplace, you'll begin to see some of those existing home sales pick up. But right now, I'd say new home construction will be the first thing to show signs of growth.
And you heard it right there. The enthusiasm in new home construction and also in the new home market is really going to continue, Jared.
Well, if the share price is any indication, those home builders have been absolutely flying this year. Danny Romero, thank you for that report. Supply chain issues became a major focus during the pandemic, and many factors were at play with access to everyday items, from toilet paper and coffee to timber and roofing materials, you name it. There was an issue making sure it arrived on time, in good shape, and with enough stock to keep up with demand. Manhattan Associates is a leading expert in helping companies manage their own supply chain, inventory, and omni-channel setups. Just released its quarterly earnings today, seeing a beat on both revenue and earnings per share. Let's now bring in Manhattan Associates CEO Eddie Capel. The current state of supply chains. We've been talking about this a lot over the last few years. Please tell me what you're seeing with your boots on the ground there.
Well, stabilization, I would say, just to begin with. We've gone from the struggle to find inventory, the supply side being impacted by the pandemic, and then overbuying to try to overcompensate, and we saw inventory levels rise beyond where consumer demand was, particularly on the soft goods side. But today, I think we're seeing inventory levels stabilize, and I certainly would expect to see a pretty good balance of demand to supply in the upcoming retail peak season.
Any challenges remaining as a holdover from the prior era, or anything you have or you're seeing on the horizon that might present obstacles in the future that you're dealing with?
Not so much obstacles. Look, consumer expectations, all of ours, continues to rise. Speed of delivery, ease of purchase, ease of access to products. So the focus on that front end of customer acquisition, maintaining customer loyalty, and servicing the customer wherever they want to be, their orders, they want them fulfilled from, whether it be, buy online, pick up in store, curbside pickup, delivered to their office, delivered to their home, as quickly as they can possibly get their hands on those products. And so opportunity, I would say, versus obstacles.
Gotcha. And I'm just reading some of your notes here. Your platform moves 150,000 pairs of shoes every hour, 300,000 tons of food every day, 90% of all prescription drug fulfillment done by you. I'm wondering, what are some of the technological advances that have allowed you to develop this system? Specifically, I'm talking about the new buzzword, AI, artificial intelligence.
Yeah. Well, a few years ago, really starting in about 2014, coming to market in 2017, and over the last 5 years, we've completely re-engineered what were already our market-leading solutions to be cloud native. So we give immediate access to new innovation now every single quarter to our customers. We're delivering new capabilities, new capabilities to help them satisfy their internal efficiency needs, help them service their customers better. And in today's ever-changing world, this immediate access to new innovation is simply imperative. As we move into the world of integrating generative AI into cloud-native platforms, we're pretty excited. We're pretty excited about the possibilities. It's early, for sure, but there are opportunities on both sides of the fence. There are opportunities for us to improve the efficiency of our company and pass those benefits on to our customers, whether it be access to voluminous amounts of voluminous data sets, asking very simple questions and getting very specific answers back, using large language models to be able to actually write software, develop code in a much more efficient way. On the other side of the fence, being able to deliver capabilities for our customers and their end consumers, being able to interact with systems in very different ways, being able to interact pretty much the way that we are versus navigating through graphical user interfaces in a very cumbersome way, to be able to service the customer, the end consumer, in a very self-service way through text-based dialogue. It's an exciting time when you think about bringing together best-in-class supply chain capabilities, modern technology platforms, and generative AI. It's a pretty exciting time, that's for sure.
I would second that, for sure. We've got time for one more. The changing consumer. We've seen a lot of behaviors morph over the last few years. You're saying retailers need to create a yes culture to build and maintain customer loyalty. Can you explain what that means?
Yeah, sure. I mean, look, I think we're all used to going into a retail store. Do you have my size and color? No, I don't. But if you come back on Saturday, maybe I will have received it between now and then. And there was a lot of no that happened through no fault of anybody, any fault of the sales associate, but there was a lot of no. Today, it's imperative that the retailer move to a yes culture. The answer is yes, I can get that for you. If I don't have it here today, the answer is still yes. You want me to ship it to your home, ship it to your office? Do you want to come by and pick it up tomorrow? Do you want to pick it up for another store? So move from that, no, I'm sorry, we don't have that, but maybe we'll have it tomorrow, to yes, just tell me how you want to get it to me to get that product to you. And that's a big objective of ours, to be able to provide the technology to move from that no culture to the yes culture.
Exciting times indeed. Definitely going to echo that. Thank you, Eddie Capel, Manhattan Associates CEO. All your markets action is ahead. Stay tuned. You're watching Yahoo Finance.
Have you seen the Barbie movie? We're talking a lot about it.
We have not, but we have made reservations or booked tickets to see Oppenheimer on Friday. Been checking every single day. That's the one we really are excited to see.
You're an Oppenheimer person. One of the rare few that we've spoken to thus far. Yes. Although there are a lot of people.
I wonder what that says about me, actually.
Yeah, it says you're intellectual.
Oh.
There you go.
It seems like the equity rally isn't showing too many signs of slowing down just yet. The Dow Jones Industrial Average closed higher on Tuesday. Index now holding on to a 12th straight winning streak. But can the rally go on? We see the Dow just barely positive today. Let's bring in Callie Cox, eToro, USA investment analyst, to discuss. Callie, great to see you as always here. We've been talking about the Fed decision expected in a few hours. We've been talking about that all day. You're looking at a very interesting situation that has arisen since the last Fed meeting, and that is the rise in cyclical stocks. So what does this mean for the Fed and investors today?
Yeah, so Jared, I see this as another sign that markets and the Fed are getting on the same page here. I mean, for the large part of the year, Powell has come out and said, we think the economy is strong. We're trying to get inflation under control. We're seeing progress there, but we're not convinced yet. So we're going to keep rates high for a while. And finally, the market is on the same page. They believe that the economy is strong, and we've seen that in surprisingly decent economic data lately, especially on the consumer side of the equation. But at the same time, if you look at Fed fund futures, basically the bond market's way of projecting where the Fed will go from here, you see that they don't expect rates to change much through the end of the year and into the middle of next year. So I see this as a good thing. I see this as markets and the Fed finally speaking the same language. And for the longest time, there was a disconnect there, which was causing a lot of angst.
Yeah, and there still might arguably be some disconnect there. We're looking at that chart on the screen of expectations for that terminal rate of the Fed funds futures. You can see rate cuts are getting priced in towards the end of the year, early next year. That might be at odds with the expectations of a soft or no landing. Talk to me about how you're approaching that with some of your clients.
Yeah, so this confused me a little bit too. And what we're hearing from customers and clients these days is that they're worried about higher rates and the potential for inflation to come back. I mean, we do a quarterly survey. It's called the Retail Investor Beat Survey. And investors told us across the board, across a 3-month and 12-month time frame, their biggest worry is inflation, which doesn't really match up with what we're seeing priced into the bond market when it comes to Fed rate projections. I mean, you'd think that if we are going to get some rate cuts in 2024, that would have to come along with some kind of economic weakness.
Sure.
I'll step back and say it's encouraging that, the Fed's dot plot is expecting this as well. I mean, Fed members do see 3 to 4 rate cuts going into next year compared to the end of this year. And, they see a little bit more weakness, but the unemployment rate projections don't necessarily show that we could hit a severe recession. So, I'll give Fed members and the markets the benefit of the doubt here. But it is still something to watch for.
I'm sure they appreciate it as well. I want to draw everybody's attention to the Wi-Fi Interactive to show another chart that you brought along here today. This is the S&P 500 earnings yield. This is that purple line that begins up here and terminates right here where I'm circling. And it is now just crossing over with the 12-month bond yield. Really interesting that something as short a duration as 1 year in the T-bill realm is yielding more than the stock market. And that just means there is an alternative. How is this changing the investment landscape, Callie?
Yeah, so this is a worrying chart, and it's for reasons that you just said, Jared. I mean, interest rates change how we think about risk and money. And if you can get essentially the same yield that you can get in the stock market through earnings on a 12-month treasury bill, which you could probably argue is a lot less risky than investing in the stock market at this moment, then some people are going to go for it. And that's what we've seen for most of this year. And so far, it looks like the equation isn't really changing. And this is where higher for longer rates can come back to bite us. The fact that there isn't as much money circulating in the system, and the fact that investors have to make these hard decisions. This, if I had to put up a bear argument, this would be the one that I'd point to. The fact that the stock market might look a little expensive at the moment, but it looks expensive, especially relative to bonds.
All right, we got one more chart on the Wi-Fi Interactive. We talked about the cyclical stocks before. You have come up with, or you're representing here, beach stocks, and this is an interesting index. Maybe you can break that down. It has been outperforming the S&P 500 and the Nasdaq this summer. You can see 15.9% versus about 8 or 9% for the benchmark indices.
So when we talk about cyclicals rebound, I mean, one area that's really become reignited here has been travel and entertainment stocks. And I can't take credit for the beach stocks acronym. My colleague Ben Laidler actually came up with it. But it's an acronym that stands for booking, entertainment, airlines, cruise, and hotel stocks. So we have this basket of beach stocks, fun little analogy given the season that we're in. And we looked at how it performed since Memorial Day, basically when summer started. And it's up about 16% compared to about an 8% rise in the S&P 500 and a slightly better rally in the Nasdaq 100, which is funny to me because everybody's talking about tech stocks and how they're dominating the market. And that's just simply not true since the beginning of June. But I think that shows that there's a recalibration going on in portfolios right now. The fact that we were way too offsides about the economy, in the middle of this year, and for good reasons. I mean, we had a banking scare happen, and growth is slowing across the board, but the economy is being resilient. And now that inflation is down to a somewhat manageable level, investors think that the Fed can pull this off and the economy might make it through unscathed.
Yeah, something noble to hope for. Always great to talk with you, Callie Cox, eToro USA Investment Analysis. Let us now do a final check of the markets, and let's go to the Wi-Fi Interactive, and we're going to take a look. The Dow in positive territory, making its epic run higher. You can see up a whopping 38 points right there. S&P 500 down about 12 basis points. NASDAQ down about 1/4%. That is all for our time today. I'm Jared Blickery.